If you're hoping for weak payrolls so the Fed may cut, you're really trying to thread a needle there.
I think the economy is slowing, but there's still pockets of strength.
The Fed can cut, but if they cut what's priced in, what essentially the market's calling for, you're not going to get any further easing in financial conditions.
They won the battle on inflation. They don't want to lose the war on the soft landing.
There's no way they can cut or signal a cut in July with this data.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get your week started live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Your equity market on the S&P 500 negative by 0.2%. It is Super Bowl week on Wall Street. It is all about Wednesday's doubleheader. Check out Wednesday, CPI in the morning, 8:30 Eastern Time. Later on in the afternoon, the Fed decides for the month of June, 2 p.m. Then a news conference with Chairman Powell at 2:30 after we spent the weekend waving goodbye to July. Citi's Andrew Hollenhorst, Lisa, going from July to September. JP Morgan, Mike Farooqi going from July to November.
At a time when it seems like the labor market's not going to give the open door to a Federal Reserve that's been looking for one to walk through, the question now is, where do they put the balance of risks? And in their statement of economic projections, this is what people are looking for. Do they upgrade their expectation of inflation the same way that the ECB did, basically decreasing the chances that one rate cut will be the beginning of a massive series of them?
Does the dot plot come down to 2 or does it come down to 1? And what do they really think about the jobs report on the FOMC? I'd love to be a fly on the wall. What we got from Citi, surprisingly strong job growth. From JP Morgan, the recent momentum in job growth. Let's just sit on that for a while. How many articles did you read over the weekend about whether that jobs data overstates the strength of the U.S. economy?
I read articles about overstating the strength, questioning just the accuracy, talking about the downgrades and the revisions that we get. Then I've got like tons of articles, including Mark Zandi coming up, talking about how the inflation rate is totally skewed by inappropriate measures of housing that have been completely manipulated and distorted by how high rates are. All these people questioning the data that the Fed is using to basically set policy, which raises a question, do they poke holes on it? Do they take it at face value? And where's the balance of risks at a time where there are a number of different signs showing a material weakening in this economy?
The questions around this in the news conference will be fascinating. Mark Zandi coming up at 8:30 Eastern Time just to continue that conversation. We need to check out Europe as well. Check out French markets. Look at the French equity market this morning. We're down more than 2%. In the bond market, yields breaking out, spreads wider, up 9 basis points on a French 10-year. The euro, just a bit weaker here. We're down 0.5%. Bear in mind, we saw 109 last week, back down to about 107.44. Marine Le Pen crushing Macron in the European election. More surprising was Macron's response to it, because this was pretty much in line with the polls.
A lot of people saying that this is the biggest ramification because he's deciding to hold a snap election, which basically there are two people, kind of two camps of thought here. One is he wants to show he still has support and solidify that at a really questionable or potential tipping point moment for Le Pen. The other idea is let's get that party in and see what they can do ahead of the general election. And if they tank the economy, well, you have been warned. So it's sort of a good question about why he's doing it now, whether it's smart, whether it's not. There are tons of columns you can read better than I think it's fascinating because it raises a question. How much can the dollar weaken at a time where there just is not an alternative? And that's really what really was raised over the weekend.
Can we pick up on your second point, the ability for them to govern? Clearly, that's what's at play here. Does he expose their inability to govern, or does he legitimise the party, the leadership, going into the election in 2027?
This is a key question at a time where it wasn't just France. Germany also, with Olaf Scholz's party coming in with the lowest showing ever in its history. This isn't just a France issue. This is the growing acceptance of far-right and populist governments worldwide, but particularly in Europe. And this raises the specter of how much elections can really influence markets in ways that are unexpected, even if these came in line with expectations.
Bloomberg's Ollie Crook joining us out of Berlin in about 10 minutes' time. Don't miss that exchange on the latest in Europe. Equity futures on the S&P 500. The scores look like this as we kick off things Monday morning. We pull back just a little bit. We're down 0.25% on the S&P. Yields with a double-digit move on Friday. Off the back of a stronger than expected headline payrolls report, we're up another 2 basis points, adding some more to that yield on a 10-year Bramo, 444.93.
So, John, you called it the Super Bowl of economics. I'm going to call it the World Cup of economics, which is this week, the doubleheader that we get on Wednesday, which is, of course, CPI coming out on 8:30, and then the Fed rate decision. I do want to just say this is highly unusual, and it comes at a week of relatively little other economic data, but we do get a series of auctions. I do think it's important to point this out. Today we get 3-year auctions. Tomorrow we get 10-year auctions. And then on Thursday, we get $22 billion of 30-year bonds at a time where actually the bond market reaction to a lot of this economic data will be pivotal. We also get, of course, jobless claims on Thursday. You raised a question a couple of weeks ago. Who's more important, Jensen or Jay? And I would add, who's more important, Jensen or Tim Cook or Jay? And that's why if you take a look at what's going to happen in the corporate world, I think that's actually almost more fascinating, which is basically we got the Worldwide Developer Conference today for Apple. How important is NVIDIA? How important is Siri going to be in its new revamped form? NVIDIA stock split, does anyone care? We'll find out. It takes effect today. And then on Thursday, we find out how much Elon Musk is going to get paid and whether people are okay with him earning $46 billion.
Can I cheat? Can I say this week it's Jay? Is that cheating?
Well, no, I think that
this week it's Jay.
Maybe. Right? I mean, the reason why I say this is because if you look at some of the top stocks, they account for more of the index than ever before. So at a certain point, if there's a material shift in one of these massive tech companies, could they overshadow Jay?
Oh, without a doubt. Over a broader time horizon, I completely agree with you, which is why I've always asked the question. If you think about Friday, and we asked it in the morning, how relevant is the payrolls report to whatever NVIDIA does? In fact, if you think that AI is in the business of destroying jobs, then quite clearly the jobs report has nothing to do with the success of NVIDIA stock, does it?
I love that point, especially considering the fact that when people say, well, if you have rates at the same level for a longer period of time, that could cause NVIDIA valuations to tank. Well, NVIDIA's valuation has actually decreased based on how much their profits have increased. So it's a good point. Keep asking.
NVIDIA doing something really unusual this morning. It's down by a third of 1% in the pre-market. Coming up this hour, here's the lineup for you. Ben Laidler of eToro on why we're in the early innings of a new bull market. Terry Haines of Pangaea Policy on the fallout from EU elections. And we'll catch up with Rubeela Farooqi of High Frequency Economics, looking ahead to this week's Fed decision. We begin with our top story, investors counting down to Wednesday's doubleheader. Ben Laidler of eToro saying this: the US economy remains on a Goldilocks trajectory, slowing enough to keep the door open to interest rate cuts while supporting near 3% GDP growth and double-digit corporate earnings growth. Wednesday's double bill of then the latest inflation data and the Fed meeting is unlikely to derail that. Ben joins us now. Ben, can you walk me through what is Goldilocks about the Friday jobs report?
I think we're in this sort of phony war right now where there's just a lot of uncertainty on the data. But I do think enough is going on, whether it's the JOLTS, whether it's the ISM manufacturing, whether it's, the productivity data, that, the economy's in pretty good shape, but it's slowing just enough, I think, as I said, to keep the door open to rate cuts coming. I don't think the market really cares whether we're going to get 1, 2, or 3 this year, as long as the next move is down. And the cost of this resilience is that we're getting good earnings growth, that companies are, we have visibility on this corporate earnings recovery. I think the market can easily live with this.
And Ben, you take it even further than that. You think we're in the early innings of a new bull market. Can you walk us through the pillars that you think this bull market is ultimately sitting on?
So one is this earnings recovery, which is fairly idiosyncratic in the US. It's not really been led by the top line. It's been led by AI. It's been led by profit margins. But I think over time that will broaden out. And in the rest of the world, where we are seeing interest rate cuts, we are seeing economies firm, it's been much more sort of top line led. So I think earnings will continue, this earnings recovery will continue and will broaden out. That's pillar one. Pillar two, the global interest rate cycle has decisively turned, and the US is the outlier here. But let's not lose sight of the fact that we have had something like 70 interest rate cuts globally this year, relative to 15, 16 hikes, and that will feed through over time into firmer economies, stronger earnings growth, and the US will follow at the back and with a lag, but I think it will ultimately follow. And I think those are the two pillars, and there's some technical support here as well. There's a lot of cash sitting on the sidelines. Sentiment is maybe lukewarm at best. When we get the inevitable pullbacks, and we've only had one this year, I think that money will come into the market, and I think that's what we've been seeing on the small dips we've seen so far.
So let's talk about John's question, which is really who's more important, John, whether we get Jay or Jensen really rising to preeminence. And sort of underpinning this, let's start on the first, Jay. RBC's Lori Calvasino saying that the risk of the S&P sinking 8% increases pretty dramatically if we do not get a Fed rate cut. Do you agree that, say, if we get better than expected economic data, at least in the short run, that could lead to a real pullback that you're talking about, that you want to buy, but that you do expect in the near term?
I disagree with that. I think, the narrative for the last 6 to 9 months has been stronger than expected economic data, pushing back of those rate cuts, and the market's up double digit. So I think the market can live with this. The market will take the higher earnings growth, and it will take the pushback in those rate cuts as long as the rate cut is still coming. And I think that is still the case. I think there is enough going on with the economic slowdown, with the productivity boom in the inflation data, that the next move is still down. I think Wednesday will be a non-event. I think we're not going to learn anything we don't already know, that inflation is sort of sticky, that the Fed is probably going to bring the dot plot down towards where the market already is, and we're just going to live to fight another day and move on.
Okay, pause. I was going to get to the whole idea of that you see the top 10 stocks in the S&P 500 rising to a record high, basically a proportion of the S&P of 35%, fragility, et cetera. You think Wednesday doesn't matter. It is a non-event. What if the Fed signals that they're going to go once this year, and possibly it's going to be in December, and they start talking about equally balanced risks and even the potential for a rate hike? That wouldn't be an event?
I think putting a rate hike back on the table would be a potentially seismic event. I don't think they're going to do that. I think they're going to walk down the three cuts to 2 cuts, maybe even 1 cut. As long as cuts stay on the table, I think the market is absolutely fine with this. And the market's already there at basically 1 cut for the year. So I think that is a non-event. I think putting a rate hike back on the table, I think that will be seismic. I think that would drive weakness. I suspect people will ultimately buy that weakness, but I think that would be a significant change.
Unequivocally bullish. Ben Laidler of eToro. Ben, it's good to catch up, sir. Thank you. It would be a Brit, wouldn't it, that calls the Super Bowl on Wednesday a non-event? It'd have to be a Brit, pouring cold water on something like that.
Hold on a second. Would you say he would have felt differently if we said it was the World Cup?
Yes. Like the Cricket World Cup final or something like that. Ben Laidler's so on board.
Exactly. Then it would be a massive event.
It was our framing. We just didn't market it properly.
So let's try this again. Welcome. Good morning. Good morning. It is the World Cup or the cricket match.
Yeah, like the cricket final on Wednesday or something like that. But I don't think it has the same ring to it. Do you?
The cricket. What is the cricket event even called?
CPI Wednesday is the most important number in finance. Ben Laidler agrees with that. It is. And what we saw change on Friday, if anything at all, can change completely again on Wednesday morning. You saw that double-digit move on a 10-year yield last week. I think we're basically unchanged on the week, on a 2-year. We've had massive moves in either direction, and we can become just as sensitive Wednesday morning to CPI, delivering a downside surprise.
I wonder, in retrospect, how much of this data will say was so noisy as to be completely confusing and, frankly, misleading. And that's what you're picking up in a lot of these reports, saying something is sort of a disconnect here when you look at some of the soft data highlighting something very different from sort of this unabated strength in the jobs market and a solid disinflation in the inflation data.
Wednesday's an important day. Going into it Monday morning, equity futures negative here by 0.2%. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Apple's Worldwide Developer Conference gets underway in Cupertino, California today. AI advancements are set to be the dominant theme. Apple's expected to unveil a new suite of features called Apple Intelligence. It will provide users with voice memo transcripts, custom emojis, and summaries of texts and emails. They're also planning a more powerful version of Siri. Sticking with tech, NVIDIA's 10-to-1 stock split has gone into effect, not really moving share prices higher this morning. The AI boom had powered the company to huge gains of more than 140% year to date. The share price surpassed $1,200 and boosted the company's valuation to $3 trillion. As Goldman's David Costin points out that one of the key reasons for the split is to increase liquidity and retail activity. The cost of owning a home in the U.S. has increased 26% since 2020. That's because of expenses, including taxes, insurance, and utilities. Those categories have soared as Americans continue to deal with higher inflation. A Bankrate survey found that home maintenance in particular is one of the bigger costs weighing on homeowners. The past 4 years of rising costs have dealt the biggest blow to Utah residents, where expenses surged 44%. And that's your brief. John.
Danny, thank you, and congratulations on the new set. Love it. Manus Cranny, Danny Berger, weekdays 5 a.m. Eastern Time. Beautiful new desk. Little bit of desk envy, just a touch.
I know.
Just a touch.
I had the same
bright
feeling.
lights around it,
Yeah,
you know?
it just kind of looks soft. They're sitting there. It looks beautiful.
It looks great. Tune in, weekdays 5 a.m. Eastern Time. Up next on the programme, Europe's far-right referendum.
There remains a majority in the Centre for Strong Europe. And that is crucial for stability. But it is also true that the extremes on the left and on the right have gained support.
That conversation up next, live from New York City this morning. Good morning. Live from New York City. Good morning to you. Equity futures right now in the S&P a little bit softer. We're down by 0.2%. The focus in Europe on the euro, we're down 0.6%. That is a weaker single currency. Euro dollar 107.39. Under surveillance this morning, Europe's far-right referendum.
There remains a majority in the Centre for Strong Europe. And that is crucial for stability. But it is also true that the extremes on the left and on the right have gained support. And this is why the result comes with great responsibility for the parties in the centre.
So here's the latest. Far-right parties gaining in European parliamentary elections. In France, President Emmanuel Macron calling a snap election to fend off rival Marine Le Pen. Italian PM Giorgia Meloni notching a win as German Chancellor Olaf Scholz's Social Democrats party sees its worst ever election turnout. Joining us to break this one down is Bloomberg's Oliver Crook. Ollie, if we've got a problem, if we want to get something fixed in Europe, who do we call now?
That's exactly the problem, John. And as you know, getting things done in Europe at the parliamentary level at the best of times is a very slow process. What you need to get things done in Europe, as we've discovered through the many crises, is strong leadership. And now you're in a position where the two biggest countries within Europe, Germany and France, have basically had a sort of pseudo-referendum on themselves as governing governments. And the people have said, no, we are not interested, whether it's the SPD with the lowest turnout or the lowest support that they've ever had on record. Emmanuel Macron coming in at about 14% with Marine Le Pen, more than twice that. That is the question here. How do you get things done if you don't have the support of the people? Macron's solution to that problem is calling a referendum, hoping that perhaps they're willing to elect something at the EU level. They're not willing to elect at the French level. Olaf Scholz does not have that lever. If they called anything, they would get absolutely crushed. The question is, who then leads in Europe? And the real winner of this, John, is certainly Giorgia Meloni, just days ahead of hosting world leaders for the G7 in Italy.
Ali, to the point that John was raising earlier, how much was it a good idea or a bad idea for Emmanuel Macron to hold this snap election for his legislature at a time where it's clear he's losing support?
Yeah, Lisa, I think this is the big question today, and I think it's an enormous gamble. People have been throwing that around, but I think it really truly is for the sort of two different questions that this brings up. On the one hand, there is this idea in France, and there always has been, that they will vote for sort of anyone but the National Front. So when you have the first round, the National Front, as it used to be called, won, then again, a lot of the French people would rally against whoever else was in opposition. But Macron is calling this at a time, A, on legislative elections, where the stakes are maybe a little bit lower than presidential, and B, at a time when there is more support than ever for the far right across Europe. So does this, in effect, he's sort of relying on this sort of French impulse to vote against National Front, or does it, for the first time, create a sort of opening for them to be tested out in a sort of soft way, in a way that could really open up the door for them in 2027?
Ollie Crook out of Berlin on the latest over the weekend. Joining us now is Terry Haines of Pangaea Policy. Terry, the president heads towards the G7 in the south of Italy, as Oliver pointed out, hosted by the Italian leader, Giorgia Meloni. Can you walk us through how difficult difficult this might be now for the likes of President Biden to really be heard, for their vision of multilateralism, to move away from isolationism. How much is that going to gain traction with the Europeans?
Well, I think it's an opportunity for Biden to show leadership, and it's an opportunity for the existing leaders of Europe to show leadership as well. You know, they've just come off a D-Day celebration where they wanted to go out of their way to show a united front, and that they were united in, you know, a variety of struggles, particularly the one in Ukraine. And they're going to have to double down on that, frankly. But they're going to have to do more than that. They're going to have to actually explain yet again, what's at stake, why it's at stake, why they're the better alternative. And that's not just Biden, that's the European leaders. You know, they've all gotten too complacent about in their belief that that everybody understands this already. They need to sell.
Is President Biden, though, fighting a war that is from, say, 20 years ago, in the sense that he's trying to appeal to a certain sort of status quo and a certain establishment order of the world that a growing population of this world, and certainly the United States, rejects? I mean, this wave of populism basically rejects a lot of what that establishment is touting. How do you see that sort of being part of the tension here?
Well, there's a lot of tension in this, and as Ali and I think others were pointing out, there's a sense here of there's a sense here that a lot of the rightist parties aren't really ready to govern yet, and you know, those rightist parties, in order to get over their own hump, are going to have to show that they are. But you know, this is a war that continues to be fought, whether it's 20 years ago or 2 or even 1. And you know, my critique of this comes down to, you know, so far Biden and European leaders have not been forceful enough, explanatory enough, persuasive enough, and they're going to have to step up their games here. And so that threat is now clearer than it was, say, 2 days ago.
So, Terry, for a lot of these countries, the number 2 issues are immigration and the cost of living, certainly the number 2 issue and number 1 issue here in the United States. And yet, when the G7 leaders get together in the south of Italy at the end of this week, they'll likely be talking about how to tap into Russian assets. And I think this is what Lisa is getting at. It's the rejection of the establishment. And do you think they are focused on the wrong thing this week?
Well, yeah, I think that to some extent that they are. You know, you know, there is a real sense, and this comes up in Biden's rhetoric about democracy being on the ballot, and the dismissal of rightist parties by a lot of the folks in Brussels. There's a real sense that they don't understand their own culpability. There's been a generation here where you know, where we've essentially had policy cul-de-sacs on an awful lot of issues, and what voters are saying and feeling and believing increasingly is that they're frustrated about that. They want some action. Combined with that, in the European context, is a sense that nationalist parties are pushing back against Brussels and really, you know, really don't want the kind of slow, you know, sludgy, you know, pseudo progress that they would characterize Brussels as exemplifying, and they want more action, and they want it now. It would behoove European leaders to address that instead of trying to give it the back of their hand, I think.
Terry, appreciate the input. Terry Haines there of Pangaea Policy down in Washington, D.C. Looking ahead to the G7. Lisa, you're right. It's a rejection of the establishment. Quite clearly, parts of the electorate have got other priorities right now. And tapping into Russian assets at the end of this week could be a big conversation for G7 leaders. You don't feel that in quite the same way for the electorate.
I wonder, from an election standpoint, who is President Biden speaking to this week? Who is Emmanuel Macron speaking to this week? Is he speaking to a core of voters to try to get them out to support them? Is he trying to appeal to those who basically have said, you're not paying enough attention to what you just talked about at home, which is immigration, which is cost of living, and that continues to be the main dominant issues?
The euro struggling a little bit this morning. We're down by 0.6%. French bonds lower, yields a bit higher. The equity market down by something like 2%. One to watch throughout this morning. Coming up on this programme, this is one to watch this week. Elon Musk's $56 billion pay package facing opposition from one of Tesla's largest shareholders. That conversation just around the corner. Equity futures this Monday morning, we're negative by 0.2% on the S&P. From New York, you're watching Bloomberg Surveillance. Equity futures just a little bit softer this morning. We're down by 0.2% on the S&P 500. On the Nasdaq, we're down by about 0.1. The Russell down by 0.7. The Russell struggled last week, worst week going back to April. As for the S&P, we can spend some time on this. Is good news bad news? Lisa, we were down 0.1% at the close on Friday.
It seems like maybe on the margins, but in general, this market feels like it's kind of divorced from some of the dynamics underpinning the bond market. And this is the reason why. Torsten Slok of Apollo put this chart out that I thought was really telling. The top 10 stocks in the S&P 500 now make up a record high 35%. So it basically is, does Jensen give any, does he really care? Excuse my language.
Sure.
But does he care?
You almost went there.
I almost went there. Does he care at all about what Fed policy is going to be?
How divorced are the fate of those stocks from what the Fed may or may not do on Wednesday?
Thank
I'll try and clean up
Very
what was
elegant.
almost,
That was great. I did.
A little bit messy. It was close, though. I would have liked it if you did. That's my style of TV. But we're not allowed to do.
No.
On a 2-year, 487.33. So we had a double-digit basis point move on Friday following a stronger than expected payrolls report. We were higher by 16 basis points at a close on a 2-year. On the week, we were up by a single basis point. And Lisa, you've been on top of this. The two-way risk in markets right now whipsawed from either direction, either side, on incoming economic data.
I just wonder at what point some of these double-digit swings in yields, the benchmark yield for the global markets, creates a problem, creates an accident in markets. So far, it hasn't. But that's sort of surprising because at a certain point, I remember back in the day, you used to think that 20 basis points of a swing in bond yields was actually significant. So at what point does this sort of create a risk just in terms of lack of certainty? We have to break out of a band because right now people say, well, as long as it's 30 basis points within a certain band, we're okay. If we get without that, then suddenly you have to wonder, does this sort of ignite a greater deal of volatility, more sort of widespread through markets?
I think this perspective is really, really important. And I'll tell you why. You're always at risk of running away with whatever the last data point was and making that the latest narrative. If you take away Friday, most of the data last week was weaker than expected. In fact, that's what we spent the week talking about, the difference between a welcome cooling and an unwelcome deterioration. It was hard to reconcile key elements of that labour market report with what we've been hearing all week last week.
Which is the reason why it's hard to know how much conviction to put in this to really cause it to change the narrative more materially. I'll add this to that. When you look at the stock market, some of the biggest, highest cap stocks, you see volatility in those shares, the greatest ever. You have never seen such valuation swings in corporate stocks ever in the history of the stock market. You pair that with the volatility that you're seeing in bond yields, you just raise a question what that signals in and of itself at a time where more generally people don't see a lot of volatility going forward.
So for a hot second, for a moment, the euro thought it was getting a break last week. Euro dollar, I think it was on Thursday. Thursday went through 109. Then backed away off the back of this stronger than expected payrolls report, backing away even more now. 107.35 on euro dollar. We're down by 0.6%. Yields in France moving in the wrong direction. This is the wrong kind of move for France. This is not about better economic data. This is about political uncertainty. And you see, at least from the equity market too, we're down by 1.8%.
And to me, this highlights all the people saying that a lot of investors are going to move away from the dollar because of political risk.
To what?
Exactly. And that's the key issue here. So at what point does this sort of create a tailwind for the dollar that previously wasn't there because there is no alternative unless you're going into Bitcoin or gold? And that's what a lot of people are looking at a time where everyone was counting on the dollar to weaken just a few months ago.
DXY stronger this morning by 0.5%. We'll keep returning to that story. Under surveillance this morning, investors looking ahead to Wednesday. We'll get the latest CPI print at 8:30 a.m. Eastern and the Fed rate decision at 2 p.m. Markets broadly expecting the Fed to hold rates steady, but hoping Fed Chair Jay Powell's press conference will offer clarity on how much the central bank may cut this year. So it's a three-part act. It's the statement, it's the projections, and then it's the news conference. I think we go sort of knee-deep into the projections when they come out at 2 p.m. and we try and work out where the dots are this time around relative to where they were just a few months ago.
I agree with you. I think the statement of economic projections will be the most important aspect of this, in part also because not only just the dots, also where they see inflation ending the year, where they see inflation next year, how they sort of parse out, and I'm curious about this in their commentary, the idea that housing costs are remaining elevated because of high rates, because you basically have less volumes of sales and then there's a greater demand than supply. I don't understand how they're going to deal with this, but it gives you a sense of the balance of risks in terms of what would make them more likely to cut versus stay on hold.
We said goodbye July as soon as the number dropped on Friday, right? I was surprised that some of those banks changed their calls.
Really?
I would have waited until Wednesday morning. I would have said sort of, yeah, it hangs by a thread. Let's see what CPI brings on Wednesday morning.
You think so?
I mean, why not? What have you got to lose?
Well, you have in terms of signaling, it's a big problem if you say the labor market is super strong, inflation is coming down, and people say, well, what's the harm in waiting?
Well, the Fed has said repeatedly that they're willing to cut even if the labor market is strong, right?
It has. It's gotten a little bit more shaky. I don't know. You've got a good point. At this point, how much are they being pressured into staying on hold? But it seems like, especially given the wage component of that particular employment report, there is enough concern on the margins that maybe this is a really sticky kind of inflation that needs a real hammer to kind of beat it over the head.
I can't read Chairman Powell, so I find it very, very hard to predict how he'll characterise the jobs report from Friday. Does anyone have any confidence around that at all? He could point to one thing and not the other and say it's inconclusive, but ultimately we're focused on inflation and the trend is clear. We're on our way back to target.
At this point, though, what's the harm in just staying on hold, not indicating any rate cuts, and saying we remain flexible to the incoming data? And that sort of is one of the questions. Look, we don't know what he's going to say, but what it ultimately comes down to is the balance of risks in terms of what they weight more heavily, either trying to kill inflation really definitively or preserving the labor market. And that's the reason why that's going to be important.
I think that's where the consensus on the committee is. Though, as we've seen a few times, the difference between the consensus and Chairman Powell, there seems to be a bit of daylight between him in the news conference and what we hear in the minutes a few weeks later.
Basically, he can't resist the dove in him. He cannot resist.
That's what it feels like sometimes.
So basically, you're expecting to come out and be like, well,
I'm not saying I'm expecting that. I'm just sitting here,
report, who knows?
Trying to demonstrate some humility and try and say that ultimately I have no idea what Chairman Powell's going to do Wednesday because I find it very difficult to read him.
All on the same page. Clears
that up. Yeah, good. OK. Let's turn to this. Secretary of State Antony Blinken returning to the Middle East for the 8th time since the war between Israel and Hamas broke out in October. Blinken is pushing for a ceasefire proposal publicly endorsed by President Biden. Blinken's trip coming after Israel freed 4 hostages from Gaza in a large-scale operation that killed at least 100 citizens. Bramo, let's talk about this. The change to the government over the weekend, a big standout here.
Yeah, Benny Gantz, basically the central or the sort of the moderate candidate, the moderate person who is part of the war cabinet, stepped down. He warned that he would step down if there wasn't a comprehensive plan going forward about how Israel was going to reestablish some sort of government to create sort of peace and stability in Gaza. How much does that really affect, Benny, what happens with Netanyahu? How much more he has to depend on far-right aspects of his political party? Very difficult to know. At this point, the point that Benny Gantz was trying to get at was a change in government later this year. All of this goes down to, are we going to get any mature change in Israel policy? Probably not in the near term, which is a reason why the U.S. is going to other types of metrics like Saudi Arabia and trying to really get some sort of other coalition together. Very difficult to get a handle of how this is going to end.
Blinken's 8th trip, and they're not getting any easier, that's for sure. Let's talk about Europe more broadly. The euro falling to its lowest level in about a month following EU elections that saw far-right parties gaining ground. French President Emmanuel Macron calling for a snap election after a crushing defeat. And in Germany, Chancellor Olaf Scholz's Social Democratic Party suffering its worst ever result. What was surprising here? Not the result. Macron's response to it. A snap election, and we'll see. Ultimately, the polls suggest that he'll face another loss, and then we'll have a conversation about their ability to govern. But does he risk legitimising the movement ahead of 2027?
It also raises a question of how much investors have fully internalized the populist wave that's sweeping this country. Because as you said, this was an election result that was expected. And yet there was a material reaction. Was it just because Emmanuel Macron held a snap election? Or is it broader? A sort of realization this is real. It's not just sort of lip service and polls. There is a clear movement away from some of this establishment that has been in place for quite a while.
Elisa, there appears to be a difference, some daylight between what leadership is focused on and what the electorate seems to be focused on. Leadership, let's take this country as an example. The president's abroad right now talking about the risk of isolationism and the dark forces of nationalism, led by people like Vladimir Putin. OK, granted, understood all of that. I can see where he's coming from. The problem is for him, at home, they're focused on the cost of living and immigration at the southern border. They're the 2 big priorities going into November. There is a lot of daylight between what he's doing in Europe today and what's happening back home that ultimately the people that will vote or not vote for him come November are focused on.
Which is the reason why we were asking Terry Haines, how much does this actually not affect at all his chances? Has no kind of weight on a lot of people in the United States that say, I'm just focused on what I can buy at the grocery store. I just want to understand what my job prospect is. I want to understand why I have no mobility in order to move because there's no available housing at a price that I can afford. All of these issues that he's not addressing as he sort of spouts highfalutin sort of ideas that don't have a direct and obvious read-through to a lot of people at home.
The policymaking is complex, but if you're focused on income streams from Russian assets 10, 20 years down the line and coming up with sophisticated ways to make sure that money goes to Ukraine and not go to the hands of the Russians, like you're just sort of, here's you and this is where the rest of the country is.
It's important for them to focus on these things. It's a question of emphasis. It's a question of messaging. And it's sort of a question of, OK, yeah, you can tout that as a win, and that might appeal to people in the business world who say, OK, that's a valuable way to move forward. OK, in the international sphere, that's a valuable way to get Ukraine funding. But on the flip side, it's not sending a message to the voters, which is what he really needs to be doing.
AMH on the ground in Italy. She's going to catch up with us tomorrow, I think. Anne-Marie, loving it, I'm sure, for the rest of this week. Is that the short straw? No, absolutely not. That is like the trip we all wanted to go on, and Anne-Marie made it happen.
Congratulations.
OK, let's turn to this one. Tesla, the CEO, Elon Musk's pay package is being put to the test at the company's annual meeting on Thursday. Norway's sovereign wealth fund, one of Tesla's biggest shareholders, saying it will vote against the $56 billion package. Bloomberg Trudell joins us now for more. Craig, walk us through this pay package and ultimately what's changed over the last couple of years.
Yeah, I mean, it's really a heck of a story because there's so many sort of, vantage points to look at this from. If you look at it from the perspective of Norway and some of the folks who have come out against it, they look at the fact that, yes, Musk hit these targets, but they've been given sort of an opening here by the judge in Delaware. The fact that there was fault taken in how this came together, the fact that the board is really sort of kept by the CEO and Elon Musk. And we haven't necessarily seen a ton of evidence to the contrary, even in the way that, things have transpired just in the last few weeks with, Musk really pulling out all the stops, the board sort of, breathlessly advocating for him. This even continued over the weekend with Musk, commenting on Norway coming out against this, suggesting that shareholders or backers of his other companies have first dibs on things that Tesla does. So I think he's really trying to kind of rally retail support in particular, and really banking on the fact that retail shareholders make up a significant portion of the shareholder base at Tesla, and this idea that he can get them on side and potentially have more luck with them than the institutional shareholders who aren't going to have a difficult time justifying, what, if I can get the performance from the past for free, I ought to.
Yeah. Craig, I am curious what the consequence is for this if, say, Elon Musk is denied his $56 billion pay. Does that mean he's going to take his toys and go home?
I think that's one of the main points that the judge in Delaware made, was this idea of you already have this guy very much incentivized to stay put at Tesla because he already has a substantial stake in the company. If he were to walk away, that stake would be much less valuable. He's kind of stuck. And I do think the board, makes this case that there's this real risk here. But, whether or not that's credible, really seems like a tricky case for them to make, in the sense that he, I think, is very aware of the fact that, a lot of the value in this company is wrapped up in his involvement. And if he were to step back, it would be really damaging to him in addition to other shareholders.
Craig, I understand that Elon Musk can be a polarizing figure, but that shouldn't matter in the eyes of the law. Let's take Musk out of it. Let's take Tesla out of it. I just wonder what kind of precedent we're setting here. If a company comes out and says, these are the milestones, if you hit them, you get paid X. And then we can go further down the line and say, you know what, I didn't like that deal. I voted for it, but ultimately, yeah, no. Craig, can we actually do that? What actually are we doing here? And what kind of precedent are we about to set?
I think it's really tricky, and it's in part, difficult to answer that question because there is no precedent. I mean, we never have seen a company, lay out a compensation package quite the way that Tesla did. And so, it does feel like, there is some reason to feel like your nose is out of joint if you're Elon Musk, and that, hey, wait a minute, my board laid out this package for me. They laid out these clear targets. I hit them. Nobody thought I could, and I did. And the issue that you run into here is the fact that, a court in Delaware, which does have, quite a bit of standing and years and years of court precedent, taking issue, I think it does cause real challenges with, sort of undoing that decision. The fact that the Delaware Court of Chancery is no, Johnny-come-lately here. They are sort of where companies are based. And I do think that there is, some concern that, the fact that this ruling came out the way it did early this year may, pose a risk to that standing. That's another element of this week's annual meeting, is the company wanting to reincorporate in Texas instead of Delaware.
Craig, appreciate the update. We'll touch base with you later this week, I'm sure. Craig Trudell there of Bloomberg on the latest with Tesla and Elon Musk's leadership. Let's get you an update on stories elsewhere with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. The bond king is about to become the stamp king. Bill Gross is auctioning his stamp collection this week, according to the FT. It's likely to fetch as much as $20 million. It's a new record. Gross has long written about his stamp collection in investor letters, saying his mom got him into the hobby. Gross is now getting out of the sector because he thinks stamps are due for a correction, that it, quote, used to have a fundamental base of kids, and that doesn't exist anymore. Bill Gross will be joining the team on Bloomberg TV at 3:30 p.m. Eastern today. A check on Southwest Airlines this morning, rising nearly 7% pre-market. The Journal reporting that Elliott Investment Management has built an almost $2 billion stake in the company. The holding makes the activist firm one of the largest investors in the U.S. carrier. Elliott reportedly plans to engage with management and push for change. Carlos Alcaraz won his first French Open title, coming from behind to defeat Alexander Zverev in a 5-set match in Paris. It's the 21-year-old's third Grand Slam title, but first on the clay of Roland Garros. The victory follows his win at the U.S. Open in 2022 and Wimbledon last year, and means Alcaraz passes countryman Rafael Nadal as the youngest player to win a Grand Slam on 3 different surfaces. The Spaniard will have a chance to defend his Wimbledon crown later this month. And that's your brief, John.
Danny, thank you. 4 hours, 19 minutes. 4 hours, 19 minutes. Can you imagine that? The standard of tennis they're playing for that long.
The physicality that's required for that is why, if you're 30 years old, you're old in this field. I just want to say that 21 seems like a good age.
Try being like 38, like Rafa Nadal.
Yes, correct.
That's where we're at.
Yes.
If you get tired after the gym after like 20 minutes, it's not even that intense. 4 hours, 19 minutes. Wow. Up next on the program, counting down to Wednesday's doubleheader.
There's no way they can cut or signal a cut in July with this data. They would have to change their reaction function and be public about it, and I don't see the Fed doing this.
That conversation just around the corner, live from New York. This is Bloomberg. Equities just a little bit softer. We're down 0.1% on the S&P. Yields a bit higher, up by 2 or 3 basis points on a 10-year, 446.11. Under surveillance this morning, counting down to Wednesday's doubleheader.
There's no way they can cut or signal a cut in July with this data. They would have to change their reaction function and be public about it, and I don't see the Fed doing this. We are in a weakening economy. There are no spare tires to speak of anymore. There's no pandemic savings. There's no huge new fiscal impulse coming.
Mohammed, just fantastic on Friday. Here's the latest this morning. All eyes on Wednesday's CPI print and Fed rate decision following Friday's hotter-than-expected payrolls report. Rubeela Farooqi of High Frequency Economics writing this. While incoming data will ultimately drive rate moves, our base case remains that the Fed will make the policy stance less restrictive this year in response to a slowing growth and inflation backdrop. Rubeela is with us right now. Rubeela, before we run away with this week and start on Wednesday, we need to start with last Friday. Do you believe that jobs data Friday morning overstates the strength of the U.S. economy?
The jobs data show us that this economy is still creating, jobs at a very fast pace. This is something that, if you look at the underlying trend, though, we're not really seeing a breakout either to the upside or downside, but the U.S. economy is still creating a lot of jobs. It's the household survey where, there's a little bit more of a concern, the unemployment rate ticking up, still very low by historical standards, still, in line with where, the Fed marks the longer run rate. But this economy is still very strong. The labor market is very supportive of incomes, of households, and we continue to see that.
In the numbers, if you take them at face value from Friday, we saw wages increase at a faster pace month over month than many people expected. Right. Yet you say that the data are pointing to little threat of inflation from labor costs. What gives you that conviction?
If you look at the average hourly earnings number on their own, yes, there's a reacceleration that we saw in the latest numbers. If you look at unit labor costs, and, these data are extremely volatile quarter to quarter. But if you look at the underlying trend, we have seen, if you look at the year-on-year changes, we are seeing a consistent improvement in productivity. And, if you look at the revision to the latest numbers on unit labor costs, a consistent deceleration in unit labor costs. Also, if you look at other numbers, right, we are seeing sort of mixed signals. So I don't want to overreact to 1 month's number. If our base case is that economic activity is slowing, that demand side of the economy is slowing, especially in the services sector. If you look at the services spending numbers in the latest 2 months, that is slower. The problem is that we've seen this before, right? We see a slowdown and then we see a rebound. So what we're looking for is a consistent slowdown. The early numbers are certainly suggesting that. So we're not expecting a reacceleration in economic activity. We've already seen a step down in household spending. It's just a matter of some more evidence, and the Fed is also looking for the same.
Can you frame how important then CPI is going to be on Wednesday in terms of either supporting your thesis of a gradual slowing, but also disinflation versus sort of rejecting it?
Right. The CPI data, we expect them to show what the PCE data is showing, right? The inflation is sort of moving sideways, really not much of an improvement right now. But what we are seeing is a deceleration, a deflation in goods prices. The services side is where, all the problem lies. That's what's boosting prices. In, the CPI versus PCE, you've got that housing component, which is much weightier in the CPI numbers. We do think that is also going to come down, but gradually. And we also think that this, ex-housing component of core services, that is also something that we're watching very carefully. And all indications are, if you see services spending, sort of moderate, then you would expect that, as that demand slows, that those price pressures will also abate. But if you look at, there's conflicting evidence, right? If you look at some of the numbers on travel, on entertainment, those numbers are still, they're still signaling that there is staying power to the services side. But we do think that we're going to see, over coming months, a moderation. The whole idea is that the U.S. economy continues to grow. The Fed has delivered over 525 basis points of tightening without causing a recession. They're going to be careful as they move forward. We think the base case still is that the U.S. economy grows, but it slows down. The momentum decelerates.
Rubeela, appreciate it. Rubeela Farooqi there, High Frequency Economics, looking ahead to Wednesday, a Fed decision and the data in the morning. Heard a similar thing from Mike Gapen. The economy may be cooling, but it's not cool. We've heard so many different versions of that, haven't we, over the last few weeks?
Michael Gapen said that he muted our coverage before we actually got the result because we were so negative, and he just disagreed. And he was sort of, doing a very non-subtle humble brag.
He's Team December, right?
Yeah, and he's been completely correct. So, as a way of sort of raising that point, it is interesting to see all the ways that people can say we have no clue what's going on and the data is messy. This from Steve Englander, basically saying the FOMC is not going to say anything because they can't, because nobody knows anything. The press conference could focus instead on immigration and R-Star rather than immediate policy moves, because you know what? They probably have more to say on those things.
Yeah, you think they will?
I don't know. No.
Then that's what the press is going to be about.
Can you imagine?
Peter Chi of Academy. The establishment survey makes it look like an incredibly strong and healthy labour market. The household survey makes it look like a very weak labour market. It is both the best of times and the worst of times. And whatever you were thinking going into Friday, you did not change your mind based on that data.
Well, it was a great kind of piece from Peter Scheer, because it just sort of underscored this disbelief of numbers that seemed so messy as to be rather unbelievable.
And then you've got a trade on it. Equities a little bit softer this morning. Coming up next, Troy Gayeski of FS Investments, Bloomberg's Josh Wingrove, and Mike Schumacher of Wells Fargo, live from New York. The second hour of Bloomberg Surveillance up next.
we are being reminded over and over again is how difficult this economy has become to understand.
You are seeing some parts of the economy slow, but it's not fallen off of a cliff.
Yes, growth is slowing, but it's slowing to a level that is still well above trend.
The Fed has the luxury of being in a strong position that they can hold off, be patient, and see how things play out.
If they're going to lean in one direction or the other, they're going to lean towards caution before cutting too quickly.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance begins right now, live from New York City this morning. Good morning, good morning. Your equity market on the S&P 500, negative by 0.1% on the S&P. This week is all about Wednesday. This is the lineup for you. Wednesday morning, CPI, 8:30 Eastern Time, onto a Fed decision at 2 p.m., 2:30 with Chairman Powell in a Fed news conference. And already this morning, a controversial take from Ben Laidler of eToro, who turned around to us about an hour ago, Lisa, and said non-event on Wednesday.
Well, it's easier to say it's a non-event than it's going to be this massive event, given the fact that we're looking at such great uncertainty, not only in just what the trajectory of the economy is, but how seriously to take the data. So at a certain point, it's fair to say that, even though it probably will move the needle. Look, a lot of people saying, and I think that Lori Calvasino is right to say that if there are no rate cuts, that's going to raise a specter of potentially a stock sell-off, particularly in the stocks that are more sensitive to how high rates currently are.
Well, let's get to stocks and look at equity futures together. Let's start with the price action. The scores look like this on the S&P 500, a little bit softer on the S&P. If I could predict what Wednesday's CPI number would bring, could you guess what the market would do? And this is an important exercise because we had a pretty hot wage growth figure on Friday. A really, really decent headline figure on payrolls, much better than expected. Yields did what you'd expect bond yields to do, and then equities fell by 0.1% on the S&P.
So, yeah, no, I have no idea. If you give me all of the information right now for the entire week, I'll have no idea how the bond market or the stock market trades in any capacity, because we've been saying not only for stocks is it macro policy, which is completely uncertain, but you also have the Worldwide Developers Conference for Apple. What if Siri disappoints? Well, all of a sudden, there's a $470 billion rally that's really at question, how quickly they can move to AI. What if NVIDIA's stock split fails? What if it actually doesn't make a needle, doesn't move the needle, considering how much those stocks have rallied? Do people say, wait a second, maybe we don't believe in the rock star of AI? Maybe his leather jacket is passé? There are all these questions that are fundamental to the market performance.
That didn't feel sincere. I'm not sure if that was the intention or not. I know you've got some bonds to sell too, 3-year, 10-year, 30-year. Do you want to try and pitch them now?
You want me to be like the snake oil salesman? You got some bonds to pitch?
Got some 3s, got some 10s, got some 30s.
Yeah, well, we've got some bond auctions. And to me, that is important also at a time where you have a market that's attenuated to any move potentially in terms of understanding the long-term trajectory of inflation. Is there a concern about sort of a stickiness perpetually? And it ends with $22 billion of 30-year notes on Thursday. How bad could that auction be if we get a hot CPI print on Wednesday?
That's a lot to look forward to a little bit later this week. Before we run away with all of that, we need to focus on this too. Just a little bit of a softer euro for you, negative by 0.6%, 107.38. French equities underperforming, bonds lower, yields up, spreads wider. Lisa, put it all together. What was the surprise over the weekend? In the polls, basically, we were expecting Le Pen to smash Macron. That's basically what we got. The surprise was that he then turned around and said, yep, snap election, just like that.
He wanted to test the true appeal in a broader legislative election, and he wanted to see if Le Pen's subordinates won, could they rule? And if they couldn't, could that really strengthen his support? It's a pretty big gamble. A lot of people weighing in on both sides. There's also this larger question of what is the alternative to the dollar and what is the potential consequence if the dollar continues to strengthen or even stay the same, as Kitchuk said, before, say, the political winds really heat up in the U.S. and all of a sudden then you have the weakening.
All of this setting the stage for the 27th French presidential election, just a few years away. Coming up this hour, Troy Gayeski of FS Investments ahead of CPI and the Fed on Wednesday. Bloomberg's Josh Wingrove ahead of President Biden's trip to the G7. And Wells Fargo's Mike Schumacher on what's needed for a September rate cut. We begin with our top story. All eyes on Wednesday's CPI print and Fed rate decision. A hotter than expected May jobs report muddying the path to rate cuts and driving yields higher. Leaving investors wondering is good news. Now, bad news. Troy Gayeski of FS Investments joins us now for more. Troy, let's start there. The data on Friday, was that good? Was it bad? I guess the answer is it depends where you looked.
Yeah, and it depends on the asset class, right? Obviously, for equities or any economically sensitive asset class, it's incredibly good news. Now, clearly, equities have to fight higher yields, which led to a round of mini multiple compression Friday, tied to this morning's futures as well. And given how elevated multiples are, again, 21.1 times forward earnings, the upside is capped as long as the inflation numbers stay relatively high. Obviously, for fixed income, as has been the case, continues to be bad news. Everyone that expected Fed to cut rather aggressively has been proven wrong yet again. So it's been a really tough spot to be in duration, and that we expect that to continue. And then we just don't expect any more meaningful multiple expansion at these relatively lofty levels.
Troy, before we get deeper into markets, walk me through what you expect on Wednesday in the news conference with Chairman Powell. If you point to the household survey, it says reach for the tin hat. If you point to the establishment survey, it says let's talk about higher rates. What do you think they will be discussing?
Yeah, I think they'll continue to stay they're data dependent and that the data is murky, as you highlighted this morning. Various surveys are painting different pictures of the economy, but the one thing that has been consistent is that the Fed is being very patient with forward cuts. We do expect them to cut 1 or 2 times by the end of the year because, as a lot of your prior guests have stated, the consumer has been softening. The labor market has moved from white hot to somewhere between warm and red hot, and you just don't have the excess savings left to continue to boost consumption. And obviously, wage growth has slowed down from very lofty numbers. So I think it's going to be data dependent. They're not going to overreact to any one survey, but ultimately, it makes sense to cut by 1 or 2 times by the end of the year.
Do you have a sense, just before we get into markets, on where the balance of risks right now in terms of potentially inflation overheating versus a recession? It seems like we've been whipsawing from week to week, depending on data that's been also whipsawing, with some people saying that the Fed's going to have to hike again next year in the face of inflation, and other people saying the Fed should cut aggressively because of weakness. Where do you fall?
Yeah, I think those are two extremes that are just unlikely, right? I mean, what we've been doing here is walking down a path of purging the economy of excess consumption capability, right? You had so much fiscal stimulus, you had so much excess savings, and it's taken time for that to gradually go away. So I'm not quite sure why people extrapolate a gradual softening of the economy to a hard landing. When you look at all the constituent parts of the economy, whether it's business, fixed investment, I mean, just look at the spends of the mega cloud scalers right now, whether it's residential housing, whether it's state and local government spending. And again, consumption has slowed, but there's nothing that appears to us that will drive unemployment higher at a fast enough rate to cause consumption to go negative. So the recession risk has dropped like a stone. It's not zero, but it's call it somewhere between 1 in 10 and 1 in 5 the next 12 months. And then on the inflation side, the probability of the Fed hiking again, unless there's some type of dramatic supply shock again, is extremely unlikely. So the reaction function is don't hike, keep rates where they are as consumption continues to gradually cool, have 1 or 2 cuts by the end of the year, and maybe the second cut's pushed into 2025.
You said, why are people looking at these two dramatic situations? And part of it is because people feel uncomfortable. Part of it's because people are impatient. But part of it is there's a real sort of tension here with stocks making all-time highs in the face of a weakening economy. And the biggest stocks in the index have greater dominance and are swinging around like never before. Does that give you pause?
Yeah, I mean, clearly the biggest concern for listed equities is as fewer and fewer companies are public now, is the fact that you have a super narrow market, right? And whenever you have a super narrow market at these lofty valuations, not just the broader S&P, but obviously the magnificent 7 minus Tesla plus Eli Lilly are about 34 times forward earnings. What you're really concerned about is idiosyncratic risk, right? Something going exceptionally wrong with 1 or 2 of the market leaders. And one of the reasons I think investors feel that this environment's just been too good to be true, particularly for listed equities, is that you've actually had the idiosyncratic risk in Tesla and to a lesser extent Apple this year. But it's been a have no fear moment, right? Because NVIDIA has turned into the greatest wealth creation machine mankind's ever seen, where you're growing revenue and earnings faster than market cap as market cap goes to $3 trillion. And then on top of that, you have these wonderful obesity treatment drugs, which are addressing, the biggest secular challenge for U.S. healthcare. So you put it all together, it's understandable why there's nervousness and caution. And clearly at these valuations, markets are priced for perfection. And you alluded to that 30-year bond auction going forward. That continues to be, in our mind, one of the most obvious endogenous risks, where we get a few sloppy options like we did a week or 2 weeks ago, and that causes yields to gap higher. And then you're going through another August to October event like we did last year, or to a lesser extent this April. So that's the most obvious risk, given where valuations and the trajectory of rates could be.
Troy, you say that's the most obvious risk. It was also the most obvious risk on December 29th, which is the last trading day of 2023. And Nvidia has doubled again. Troy, I just wonder,
yes.
are we having the right conversation? Are we asking the right questions?
Well, I think you are. I mean, look, I think the last 7 to 10 years, there's just been this transformation of the U.S. and even global economy from where you had more diversified sources of growth and revenue and earnings to one where it's become really a winner-take-all economy, right? Where all the wealth flows up to the U.S. champions. More and more companies have stayed private. There's fewer opportunities to diversify, within public listed equities, which is, one of the reasons the alternative industry has grown what it has. And so focusing on that idiosyncratic risk is very valid. It's just the strength of the growth has overwhelmed that. And, as I often say, one of the biggest surprises this cycle is that despite the Fed tightening at the pace they have and continuing to drain their balance sheet, albeit they're in the process of tapering, equity markets re-expanded from 15.75 to 21.1 times forward earnings during the most aggressive tightening cycle in history. So I think people are focused on the right things, but the flip side is that sometimes the underlying organic strength of earnings can overwhelm more broader macro concerns. And clearly, again, asset classes have differentiated. Equities should be outperform in a stronger economic environment with more persistent inflation. And fixed income should continue to struggle because the probability of forward hikes continues to drop, or forward cuts continues to drop, and obviously the magnitude has as well.
Got it. Troy, a lot to think about. Troy Gayeski there of FS Investments. The S&P 500 year to date, Lisa, up 12%.
Did you hear what he had to say? Auctions. That is really important. We have 50...
Out of everything he said that we need to unpack, that was the thing that jumped out.
Well, to me, it's the duration risk, that the upside risk to bond yields is the biggest risk facing equity markets, and that, frankly, just profitability is powered through that. And that idea, to me, is a really interesting one. I know FS Investments with Laura Rame has also been talking about the idea of stickier inflation and stickier yields. Question is, how long can people power through that? And is that the reality at a time where other people are saying, actually, it's a great time to buy bonds?
They're the only house saying it, that maybe these supply dynamics reassert themselves as the year grows older, we get closer to November and start thinking about policies a little bit more.
Yeah, although people are talking about, a Liz Truss moment or some kind of potentially catalytic moment that caused some sort of rise in yields. This is still a risk. I mean, that's sort of a key question to your point, kind of how you started the show, which is what will Jerome Powell say in this news conference that could potentially move the needle? And that ongoing continues to be a concern at a time where he tilts dovish. He can't help himself. And that's been the most supportive thing for bonds going forward.
The 10-year yields are higher by another 2 basis points or so this morning, getting closer again to about 450. Let's get you an update on stories elsewhere. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. NVIDIA's 10-to-1 stock split will take place today. The AI boom has powered the company to huge gains of more than 140% year to date. The share price has surpassed $1,200. The valuation past $3 trillion. And to that point, Goldman's David Kostin says that one of the key reasons for the split is to both increase liquidity and retail activity. Secretary of State Antony Blinken will head to the Middle East today, looking to push a last-ditch ceasefire proposal that has so far been dismissed by both Israel and Hamas. Blinken will meet with the president of Egypt before heading to Israel, where he's expected to meet with Prime Minister Benjamin Netanyahu. It's Blinken's 8th visit to the Middle East since the war broke out in October. Donald Trump has his first meeting with his probation officer today. Sources tell Bloomberg that the former president will do the interview virtually from his Mar-a-Lago estate. The officer will then submit a sentencing recommendation for Trump. The presumptive Republican nominee is scheduled to be sentenced by a judge in New York on July 11th, and that is just days before the start of the Republican National Convention. And that's your Bloomberg Brief. John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the program, a challenging G7 coming up for President Biden.
I think it's an opportunity for Biden to show leadership, and it's an opportunity for the existing leaders of Europe to show leadership as well.
We'll get the latest from the team here at Bloomberg just around the corner from New York City. Good morning. This morning starts in France. Good morning to you. Focusing on France for all the wrong reasons for Emmanuel Macron. Yields are higher by 10 basis points here, approaching 320 on a French 10-year highs for the year. Euro weaker, negative 0.5%. Lisa, equities a struggle.
And what you pointed out was that this was not unexpected in terms of the gains by some of the more populist or far-right groups. But the reaction that Emmanuel Macron had to it about calling a snap election in the legislature raises a lot of questions about A, will his party win? And B, what will happen if they don't? Well, does it legitimize, to your point, the far-right party, or does it show that it can't govern, which is Emmanuel Macron's bet?
Busy month coming up for European politics. Couple of dates for you. June 30, first round results. July 7, second round. British election in the mix as well. July 4th. More on that a little bit later. Under surveillance this morning, a challenging G7 coming up for President Biden.
I think it's an opportunity for Biden to show leadership, and it's an opportunity for the existing leaders of Europe to show leadership as well. They're going to have to actually explain yet again what's at stake, why it's at stake, why they're the better alternative. And that's not just Biden, that's the European leaders.
It's the latest with the G7 kicking off this week. President Biden facing challenges at home and abroad. Wars in Ukraine and Israel denting his polling numbers as U.S. officials look to finalize a $50 billion loan to Ukraine using frozen Russian assets. Bloomberg's Josh Wingrove joins us for more. Josh, just what is at stake for the president this week?
John wants to show that democracies can still do things. Of course, the G7 in recent years had sort of given way to the G20, where sort of all eyes were focused. Now it's sort of that they don't really get as much done in the G20 anymore. Russia, China really blocked consensus on that. So you've got G7 leaders, many of whom are unlikely to be there at the next meeting, or at least it's up in the air whether they'll be there at the next meeting. Of course, Joe Biden has an election himself this year. Kind of have this, kick at the can to try to do something in particular on Russia and Ukraine. That's where the focus is. You talked about the $50 billion, or at least $50 billion. It seems like there was progress on that over the weekend when Joe Biden was in France, spoke with Macron about this, indicated that they came to some sort of agreement, but hasn't given any more details. That, I think, will be the big top-line thing. But we're also going to see, and have seen in the G7 ministerials, including the finance ministers, focus on China and that sort of thing. The U.S., of course, is looking for other countries to follow it in some of the steps it's taken to add tariffs or restrictions on Chinese exports, in particular around sort of critical technologies and goods. So keep an eye on that. We'll be watching for China. We'll be watching for whether they get that deal on finding some way to squeeze cash out of these seized assets. It's genuinely a dispute over how best to do that, though.
Josh, traditionally, these are big opportunities in election years to demonstrate leadership, to act presidential. I say traditionally because these days, isolationism seems to be playing quite well with certain segments of the electorate right here in the United States. From your perspective, do you think this week is an asset for the president or a liability looking ahead to November?
I think time will tell, but I'm very sure that Joe Biden thinks it's an asset for him, and he will want to have it on show. I think he'll look at these results in Europe and see less the rise of the far right in certain countries and more the fact that the overall composition of the parliament seems to have not changed all that much, and that Ursula von der Leyen seems to have the inside track there. That's a leader that Joe Biden likes quite a lot. So I think he will see that as the middle more or less holding rather than the right ascending. I think we'll hear a lot about that. Of course, we'll hear the same next month at the NATO Leaders Summit here in Washington. He wants to put on a show. Remember, of course, Joe Biden and Donald Trump have very different views on this. Trump was not a huge fan of the G7, even less of a fan of NATO members that don't pay the 2% or spend 2% of GDP on defense spending. A lot of concern within those countries that if Trump wins, that the status quo at the very least is not going to continue. So, we're going to see Joe Biden put a big banner up on it. We're ramping up, though, here. This election is really taking off. You're mentioning the European election dates. We've got a debate here, of course, John, in a few weeks. First debate between Trump and Biden. All eyes will be on that. The polling's still really tight right now. It looks like if Biden has a path to a second term, it runs mostly through the north. Could be a razor-thin election, so every moment matters, and this one will be about showing unity with the Europeans.
Josh, you said a couple of things that I want to dig into, that basically President Biden is putting on a show at the G7. Who is this show for? given that he has already the voters that are looking for some of the messaging that he's putting out there at this G7 meeting?
I think they're trying to remind voters what Trump has said he would do. A lot of polls have shown that people aren't really tuned in. Even in recent weeks and months, when we talk to voters, they're not even sure necessarily who's running. So I think we sometimes get ahead of ourselves, sort of assuming when people check into the process. So I think he just wants to say that maybe there are voters out there who think that democracy is at stake, and that is his argument, or that might think that if he framed it that way. Now, there's reason to be skeptical about whether that's all that big a pool of voters, and there's polling that shows that the economy remains the number one issue, and that any moment spent talking about not inflation is maybe a moment that some Democrats will scratch their heads over. It's a little bit up in the air. But Biden more or less wants to campaign on sort of American exceptionalism, America's standing in the world, whereas Trump has much more of an isolationist view, and you wouldn't see him necessarily wanting to trumpet the same things.
As we've been talking about voters on the show this morning, voters have really cared about immigration and inflation. Those are two of the biggest issues that they've been putting out there. From an economic perspective, and this is a big economic week, people also very much looking at both of those features, maybe for different reasons. How much do you expect what we saw from President Biden in terms of curtailing some of the asylum seekers at the southern border from coming in as sort of the opening salvo to limit inflation? In other words, inflation, we're going to see lower immigration regardless of who wins the election.
I think that's true. I think the hopes for comprehensive immigration reform are very, very, very low, regardless of what happens in the House, Senate, and presidency. So whether it's Trump or Biden, there will continue to be some restrictions at the border. But of course, Trump would go farther and has talked about mass deportation. So if the lens is economic and workforce, that is a big difference between the two. We're still watching to see how these changes that Biden has announced take shape. Some of our colleagues, including Nadia Lopez, went to the border last week, and it seemed to be a lot of confusion, a lot of people still coming in, not clear how quickly they will be removed or how quickly these changes are taking place. But immigration is a key one. Biden seems to have decided that he's willing to tolerate the risk from the left. Progressives don't like the moves he made, nor do prominent lawmakers, including Senator Padilla from California. He seems to have basically gambled that those people will vote for him anyway, and that there are voters in the middle that he can get by sort of taking action on the border, and has said that the U.S. risks losing public support for the very notion of immigration if it doesn't get a handle on things in a more orderly way. And so that's what he's doing there. They're both cracking down on it, but the measure to which is quite different. And so, when Trump is talking about deportations and that sort of thing, I think it's a big difference between the two.
Josh, the most important question this morning, why are you in Washington and not in the south of Italy? What went wrong?
I'm leaving in a couple days, but my Oilers, Jonathan, have game 2 here. So I want to, don my jersey tonight and be sure
you make it happen
before hitting the road.
Josh, thank you.
Yes.
Josh Wingrove of Bloomberg down in Washington, D.C. That's the trip everyone wanted to go on.
Yeah.
Like for the last 12 months, we've been talking about that trip.
And he basically is going to go, but late, so that he can watch the game and put on his jersey.
That makes sense.
Yeah, well,
and then stay a little bit longer, extend the weekend. Got things to do.
What did we do wrong, John?
Why are we here? Don't know. I think it was TK. TK 12 months ago talked about how we need to go to the G7 in Italy.
It's going to be important.
Yeah.
We care about Ukrainian
Super important.
funding.
Absolutely. Only Lisa could break down the sophisticated nature of this potential loan that they could come up with to tap into Russian assets.
Oh, yeah, it's fascinating.
I'll do it for you.
And implied interest going forward. Yeah. I'll do a detailed analysis. Do I get to go?
A chat with management a little bit later on why Bramo must go and why I must supervise and go alongside her.
We should have a poll.
We'll
people write in if you think that we should go.
You can do one. Sure.
If
you
it
make that happen.
Gets a certain level, we get to go.
See if management comes along for the ride. I doubt it. Coming up, Apple set to unveil a suite of AI-themed features at its developer conference. That stock is positive, a third of 1%. That conversation just around the corner. More on what the new iPhone's going to look like in September. Seconds away. Don't miss that. Equity futures on the S&P 500 negative by 0.1%, just a little bit softer here. On the Nasdaq, we're down by 0.04, with a fantastic jobs print on the headline number with a big asterisk, and we'll talk about that asterisk in just a moment. Equities were down by only 0.1%, even with this move in the bond market. So switch up the board and get to the bond market. A double-digit basis point move at the front end of the curve. We had a 16 basis point move higher on a 2-year on Friday. Add a little bit more weight to this yield curve again, up by almost a basis point on a 2-year to 489.30. Just pulling up the auctions on my Bloomberg terminal for you because Lisa gets excited about these things. ECO20 space US.
Today.
Yeah, and I've got it. Yeah, 3-year, 58 billion. Then we get 39 billion 10-year notes, 22 billion 30-year bonds, right? That's the lineup.
Thank you.
No, anytime.
That was
I'll
great.
do it on repeat for you.
Well, I mean,
of those maturities, which one's the big one?
Well, I think it'll be interesting. 10 years always the biggest, just because people tend to see that as sort of the preeminent gauge of longer-term inflation expectations. But that's Tuesday. So I actually find it more interesting to see what happens with the 30-year bond auction of $22 billion of notes on Thursday, because that comes after what we get with CPI, after the FOMC rate decision. So after PPI, you could potentially, if there are hotter than expected reads, could that be messy? Could that lead to what Troy Gayeski was talking about?
Interesting. Just a bit more investor pushback.
Well, I mean, if you get hot prints, you can imagine that that will be the true gauge of just how concerned people are, that they don't understand the underlying inflation. Because granted, people come on the show and it's various shades of I don't know. I mean, basically, that's what everybody keeps saying. You know, lack of certainty is sort of the phrase du jour, and this is sort of what you're going to see in terms of just how volatile some of these auctions can be.
CPI, Wednesday morning. We'll get to the weekend in just a moment. Let's just turn the page and go to the FX market. The euro, a little bit weaker this morning. We're negative by 0.5%. Euro dollar 107.46. The French snap election. Let's sit on this just for a moment. Lisa, we'll go through the details of this, but were you surprised to see a much weaker euro off the back of this news over the weekend?
Given the fact that it was exactly in line with projections, yeah. And actually, it raises the point that a lot of people have been making, which is you can't really bet on elections, on politics. It's like staring into the sun. But then it happens and people do respond. It is a market-moving event. In this case, it was because of what Emmanuel Macron did. He basically gave the far-right party a chance to legitimize their governing abilities. But at the same time, it does feel like people are not actually pricing in some of the projections in the polls more broadly with elections.
Based on how many elections there are this year, we'll be staring at the sun a fair bit, right?
We could go to Puglia and do that.
In Europe, we should go to Puglia and do that.
The sun is much brighter there.
Should be covering the G7, shouldn't we? I'm sort of speaking directly to
one person.
One person. Why aren't we doing that? Under surveillance this morning, counting down to Wednesday's doubleheader. We'll get the CPI print at 8:30 Eastern Time, a Fed rate decision at 2 p.m. and Chairman Powell's news conference 30 minutes later. This is a three-part act. It's the statement, the news conference, but also the outlook, the projections. We did a survey here at Bloomberg. 41% of economists expect the Fed to signal 2 cuts in the dot plot for the year. An equal number expect the forecast to show just 1 or no cuts at all. That just gives you a sense of the expectations going into Wednesday.
And shaping those expectations with his statement of economic projections. And Deutsche Bank talked about how incredibly rare it is, first of all, to get CPI and a Fed rate decision on the same day, how much the Fed's going to have to readjust the message depending on the CPI that comes out after already having a full day of their meeting, but also saying that given where inflation expectations are, that could really shift the tone of the meeting in a more substantial way.
You'd have to imagine, and we said this Friday, Neil Kashkari feeling pretty good going to this 2-day meeting that starts tomorrow?
Well, Neil Kashkari, yeah, he thinks that maybe we should not cut at all and that next year he should potentially see either potentially 1 cut or even a hike. But at this point, it just seems so uncertain because of a lot of the weakening economic data, too. And that's the reason why we've just seen a complete lack of conviction on pretty much every guest that's come on this show.
Apollo agrees with him. SocGen agrees with him. Others agree with him too. Elsewhere in Europe, the latest political news. Far-right parties gaining ground in European elections. French President Emmanuel Macron calling for a snap legislative vote in a bid to fend off rival Marine Le Pen. This as German Chancellor Olaf Scholz's Social Democrats party suffers its worst ever results. Meanwhile, in Italy, the PM, Giorgia Meloni, notched a win. So Kashkari's going into this 2-day meeting feeling good. Don't you think that the Prime Minister of Italy, Giorgia Meloni's going into this G7 feeling pretty good as well?
She's where the energy's at. And at this point, you have to wonder how much that shifts the tone of the G7. You know, we were talking about how President Biden's going to try to talk about the threat to democracy and have these very significant moments to really signal status quo. At the same time, you wonder how much of a stage Bologna gets and how much more attention she gets, how much more discussion there is about immigration, about inflation, about countering some of the dependence on certain nations for energy costs, et cetera. There are a lot of other issues that it would be very curious if they would address in a more comprehensive way.
I was hoping that we'd catch up with Anne-Marie tomorrow. I've just been told it won't be until Wednesday.
Oh.
You need a little bit of time to acclimatise, apparently, just to prepare, you know, to get used to your surroundings.
It's difficult when it's really nice and
I'm not jealous
warm.
at all. I'm going to do this for days. Let's talk about Apple. Developer conference getting underway in California today. The company said to unveil a suite of new AI-themed features, including text and email summaries, custom emojis, and a more powerful version of Siri. Bloomberg's Dana Wollman joins us now for more. Dana, wonderful to catch up with you. Thanks for being with us.
Thanks for having me.
I am absolutely clueless as to what to expect on this iPhone later this year. Can you walk us through in very simple terms how this thing is going to change?
So Apple, belatedly, many would argue, is going to be working artificial intelligence into just about every aspect of the user experience. That includes summarizing notifications, web pages, emails, enhanced photo editing features, and as you say, AI emoji, where if you're typing and maybe there isn't already an emoji that fits what you're describing, it'll make it up on the fly. At least that's what we've reported. And you can see I'm a little giddy. That sounds especially cool to me, at least.
Do you think Apple is making it up on the fly?
Do I think Apple is making it up on the fly?
Are they very behind and trying to launch things when maybe they're not ready to be launched?
I think they're certainly playing catch up. And I think today's offering is expected to be pretty robust. I think out of a roughly 2-hour presentation, our reporter, Mark Gurman, estimates this will take about half of that presentation. So plenty of features on offer. However, he also expects that they will be listed as beta when the software fully launches in the fall. And that is unusual for Apple. Usually what you see in the fall is really polished, final software, very few bugs. But this will be a little different. It'll be listed as beta, and users, more importantly, too, will be asked to opt in. So you won't be automatically looped into this whole AI ecosystem, this whole AI framework, if you're uncomfortable with it.
Yeah, it raises a question. How high is the bar to really start a new super cycle for purchases for iPhones, right? Is this enough to get people in the door? Not that there really isn't a line outside the Apple Store, but to make sure that they get summarized notifications or cool new emojis that are made on the spot. Do you get a sense from your reporting of how high the bar actually is to restart interest in purchases?
I think, and this is obviously take this with a grain of salt. I'm not an industry analyst, just an editor, but I do think there is chances are fairly good of a super cycle of phones, especially if our reporting is correct, that the AI features will be limited to the very newest iPhones, which is a little unusual for Apple too. Historically, software upgrades roll back quite a few generations. But these features in aggregate do sound pretty neat. And I say that not as an editor, but just as a regular consumer. And I think it could indeed prompt people to upgrade, especially if they were already holding out. Maybe they had already paid off the installments on their phones. They were already ready. This could possibly be a notable enough upgrade. And we haven't even talked about the way that iOS itself is going to be getting a facelift. Beyond just the AI features, the look and feel of the OS is going to be different as well.
So I have to say, just because I'm a contrarian by nature, part of me wonders, first of all, to John's point, how much we could see another Microsoft moment where they unveiled certain AI aspects before they were ready. And there were some pretty big snafus that raised a lot of alarms and brought a lot of bad press. But B, whether people are concerned it's moving too quickly without a real sense on some of the ramifications.
I do think Apple is going to need to discuss security really thoroughly in its presentation today, specifically how the data is handled when it's processed in the cloud. Historically, Apple has really talked up the benefit of on-site, on-chip, on-device processing. But for these kind of tasks, it's going to probably have no choice but to offload at least some of that processing to the cloud. So it's going to have to spend some time talking about the security of the chips that it uses in these AI servers.
Daniel was describing me, someone who's paid off their phone, hasn't upgraded for a number of years, and actually over the weekend considered things and then thought, I might as well wait until September. and see what they come up with. I'm also a person who's never used Siri, ever, literally ever, on my iPhone. Because all I hear is that it's absolutely useless, so what's the point?
Right. So the question is, how high is the bar for you, Jonathan Ferro, who's going to represent all of the people who have delayed their iPhone purchases? Here is your mascot. There is a question about whether what you just heard is cool enough for you to get a new phone, that it comes up with a sort of bespoke emoji.
So my issue is that FaceTime's just not working anymore for me, and that the headphones don't work either, that it's sort of cut in and out when you're trying to have a conversation with someone. It just sort of goes silent. Am I the only one who's experiencing this?
No, I've experienced it.
You've experienced it too?
Yeah, I have. But
is it a headphone issue or is it a headset, a hardware issue, the phone?
Or is it an issue of just reception in a particular spot?
It's Wi-Fi, so it can't be.
Yeah, well,
I
don't know if you know. Please write in also. But I think it's a good point, which is, in other words, people are used to using their phones for specific things. Is it really going to move the needle for them to be able to get new things? I think there's a subset of younger individuals who have their parents' credit card who,
this sounds close to home.
Try to get the new things.
What is it about Apple that just becomes a complaint about your personal life? And not just you, for me too. That's the company, right? I'm just hearing from a producer, AirPods don't work on FaceTime. There's confirmation.
Interesting.
2 sources.
All right, there you go. Then it means it's true.
Dana, thank you. I'm not sure if Dana would sign off on that one, but yeah. Dana Wollman of Bloomberg on the latest with Apple. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. On Sunday night during a rally in Las Vegas, Donald Trump said that he would scrap taxes on tipped earnings for hospitality workers if he wins the presidential election. The pledge signals Trump's bid to appeal to Nevada's mass service industry, dominated by young workers and people of color, 2 groups that he is trying to focus on ahead of the Republican National Convention in July. Former Israeli Army General Benny Gantz has resigned from the country's emergency government over the weekend. Gantz has been critical of Prime Minister Benjamin Netanyahu's handling of the war with Hamas. His departure won't cause the ruling coalition to collapse, but it does leave the government without a moderate voice, and it makes Netanyahu more reliant on his right-wing coalition partners. The cost of owning a home in the U.S. has increased 26% since 2020. Expenses including taxes, insurance, and maintenance have all soared. The past 4 years of inflation dealt the biggest blow to homeowners in Utah, where expenses surged 44%. And that's your brief. John.
Danny, thank you. More from Danny again in about 30 minutes' time. Up next on the programme, aiming for a soft landing.
I think Fed cuts, preemptive cuts, are essential for the soft landing to continue. If inflation doesn't let them do that, I think then we're looking at a bigger slowdown.
That's up next. This is Bloomberg. Live from New York City, equity futures here just about unchanged on the S&P 500 this Monday morning. We're going nowhere. Yields are a little bit higher by 2 or 3 basis points after a double-digit basis point move on Friday, getting closer to 450 again at 446.31. Under surveillance this morning, aiming for a soft landing.
Look at market pricing. We're priced for a soft landing. So what's the risk to that? A recession, I would argue, or a bigger slowdown. The Fed can cut, but if they cut what's priced in, what essentially the market's calling for, you're not going to get any further easing in financial conditions. So I think Fed cuts, preemptive cuts, are essential for the soft landing to continue. If inflation doesn't let them do that, I think then we're looking at a bigger slowdown.
So here's the latest. Traders pushing out rate cut expectations following a stronger than expected May jobs report. Investors now bracing for Wednesday's Fed and CPI doubleheader. Mike Schumacher of Wells Fargo writing this: the Fed needs to see 2 to 3 consecutive good inflation reports before easing. I think this unfriendly jobs report resets the count to 0. So this means a lot of data have to behave very nicely for a September ease to be in place. Mike Schumacher joined us now for more. Mike, wonderful to get your perspective on quite a choppy week last week. 2 very different stories. We had weak data and bonds rallying, finished the week with strong data and bonds selling off. Mike, overall, a noisy journey to absolutely nowhere. Is there anything that you see that tells you that sometime soon we break out of this range?
No, really, it's all about inflation, John. So the Fed needs to see inflation behave a bit better and at least stop throwing questionable numbers out there. So last week was bad, frankly, on the inflation front. We get a huge number coming up on Wednesday that's much more important than this past Friday. Nonetheless, the inflation story dominates, and I think until that really goes in a better direction for the Fed, you're going to see this messiness in markets. You see a lot of disarray at the FOMC. I recognize it's been the blackout period, but that'll change in a couple days. We'll hear a lot of people weighing in. And it's going to be very difficult for policymakers to get excited about a rate cut unless CPI actually is decent.
Well, let's start Wednesday morning. What do you define as decent, and what would you expect to see Wednesday at 8:30?
Yeah, core can't be worse than 0.3. So 0.25 would be nice, unrounded, but 0.3 is a relatively poor number, and 0.4 is just a Fed killer at this point. So anything notably above 0.3 is a real problem for the Fed right now.
Given the fact that you think that that would reset everything to 0 rate cuts this year, how much does that affect your macro call, particularly on risk assets, on equities, on some of the riskier credit that's rallied disproportionately this year?
Yeah, Chris Harvey is still fairly bullish, so I'll defer to him. As far as more broadly thinking about risk with respect to high-yield bonds, things like that, the Fed keeping rates high is pretty tough in the longer term for credit. So I think it sort of has an erosion type of an effect. People look at carry, say, well, it's become more negative. It means maybe in the very near term I want to buy credit, but also it increases the chance of defaults going up. So I think in the longer term it's a negative for risk. You're probably not going to hit a tipping point. So if CPI does come out at 0.32 or something on core on Wednesday, is that the death knell for risk? I doubt it, but it's a negative in our view.
Given the fact that you actually think that there's a quite considerable bar at this point to be crossed on Wednesday with CPI and then the Fed messaging, do you think it's important? And this seems like a silly question, but we started the show with a guest who said it's kind of a non-event. Do you agree?
CPI is a non-event?
CPI
no,
and then
the market
and then
didn't
the
get
FOMC.
that notice. So, no, that's clearly not a non-event. I think that's a huge event, frankly. So CPI has been the biggest market mover for the better part of the last 2 years. It's not going to change on Wednesday. A big number either way. So something like a 0.2 or a 0.4, markets will go bonkers. Now, as far as the Fed commentary itself, that's the secondary event in our view. The Fed's not going to move Wednesday. That's no secret. Yeah, it might tweak the dots a little bit. Big deal. But the bigger story is CPI. Does it really change the chance in a meaningful way the Fed really could cut this year? So the market's priced for 30-odd basis points. It's come way down, as we all know. CPI might put the hammer in that. That's the story at CPI Wednesday morning. It's not really the Fed.
Can you define bonkers? I mean, what asset class do you think is going to move the most, and what does bonkers look like?
Sure. Think about rate moves on Friday. So we had 15-plus basis points and a bunch of the on-the-run treasuries. If you get CPI coming in, let's say at 0.2, so a very good number, I wouldn't be surprised at all if something like the 10-year Treasury yield drops 15 basis points in the session, 2 years down 20 basis points. That's a big number. Those are big numbers. And if you flip that and say, well, okay, instead of 0.2, let's say we get a 0.4, do we get a somewhat symmetric response? Probably fairly close, I would guess. So something on the order of 15-odd basis points if the miss is 0.1 either way in the 10-year, that's a big number.
Mike, you've said for a while that when we start pricing in rate cuts properly, it won't just be one or two. It will be a lot. Do you still stand by that? Do you still lean away from this sort of mid-cycle adjustment argument?
I do. So it's interesting, John, and I think here is a key point. You've got to differentiate with the Fed or any other central bank for that matter, what it actually does versus what the market prices. And we think the market's going to run with it whenever that first ease happens, whether it's probably not July, but maybe September, November, December, who knows. Right after that, we think the market prices a lot more easing. And just to give you some context, if you look at market pricing right now, from September of this year to September of next year, forwards imply about 90 basis points, maybe 95, differentiation in SOFR. And history would tell you that's probably 225 to 50 basis points. So we think the market could price probably not another 125 basis points versus forwards, but perhaps 75. That would be enormous. So yes, we stand by that story. We think the market's going to run ahead of the Fed whenever that rate cut happens to happen.
Well, let's push that through the yield curve. The 2-year at the moment on my screen is just short of 490. We're about 489. The 10-year at the moment is about 446. So we've got a 2-year minus 10-year in the negative 40s. Now, Mike, you know what the consensus trade was at the start of the year. The consensus trade at the start of the year was bull steepener, let's go, this Fed's going to cut interest rates. Is it still too early to put that trade on?
Probably too early to put on steepeners, John. What we think, though, is that when the Fed actually comes in, you want to put on long-duration trades. But in our view, clients are best off waiting. Trying to guesstimate that first move by the Fed, it's been a losing game. We tried, we missed. Others have tried, they've missed. The Fed's tried, it's missed. So if you look at historical moves, and I recognize you can always make the argument this time is different, but still, usually the long duration trade does well for a couple of quarters after that first rate cut. Curve moves, not so much. So our advice to clients has been pretty simple. Don't try to estimate or guess or whatever you want to call it when the Fed is going to move. Wait for that actual rate cut, then get long duration.
And then you think year end we're in the threes, right? Sort of high threes on a 10-year?
High threes, maybe low fours, 40s, 440 right now is the forward rate. I think probably low fours is the right call. So 4-ish plus or minus 10 to 15 basis points. That sounds about right to me.
I'm still thinking about bonkers, and not just because it does fit into the conversation you've been having with John.
Hey, it's Monday morning. Come on.
Well, I mean, it's a bonkers morning. It's a bonkers week. John was talking about with sort of where this sort of leaves you with bond bets is an important one. I want to go back to just the moves that we've seen and how volatile things have been intraday. The fact that we've seen these 20 basis point moves, even though you expect maybe, 30 basis point move by year end, it's how we get there. Does it worry you that we've seen such massive swings in the benchmark rate that sets the valuation for a broad swath of financial instruments?
What I find interesting, actually, is that we've seen such big moves, and as John noted, they effectively canceled themselves out last week. So a ton of choppiness, call it intraday and intra-week, and yet not going anywhere very rapidly. That, to me, is a bit troubling. People don't really know how to read the tea leaves just yet, and that's why I think each subsequent inflation print's getting more and more important. It probably should be the opposite. This stage of the cycle, you would think every data point would become less relevant because the path would be clear, but it just hasn't worked out that way. So I do worry about this idea that markets are really volatile day to day, but if you look at week to week or month to month, not as much.
Mike Schumacher of Wells Fargo. Mike, appreciate the update. Thank you, sir. And great framing at the end of that conversation with Lisa. If you think about last week, if you were at work every single day, Monday through Thursday, it was like the economy's slowing down. You'd have a completely different picture of the world if you took the whole week up and came in Friday morning and just looked at the jobs report. Just hard to reconcile Friday's data with what we'd heard the rest of the week.
It just raises this question, who's participating in the roller coaster? Are people changing their narrative daily? Is it a bunch of algos? Is there added fragility to the market because of how much things have been swinging? You talk about potentially getting down to 4% by the end of the year on a 10-year, but the path there is so dramatic that it actually looks quite different. And in the process, does something break given how instrumental this rate is to a broader swath of the market?
Speaking of really, really sensible framing, this from Ian Lingen, good friend of this programme, over at BMO. Ongoing resilience on the jobs front won't in and of itself delay a Fed cut, but it does remove employment as a potential trigger for a reduction in policy rates. Said differently, he goes on to say, the FOMC will still see 4 additional CPI prints between now and September, and that decision, leaving a Q3 rate cut as a very real possibility in the event the inflation data begins to conform with the Fed's target. So Andrew Hoddenhorst, I think, is out at September. I think Alan Zettler and Morgan Stanley out at September. They probably agree with that sentiment this morning.
The idea that the conviction that inflation truly is coming down will take more than just Wednesday. And that, I think, is what a lot of people were saying when they said that was the sound of the door slamming on a July rate cut, because there just isn't enough data to really give the Fed officials confidence.
For the record, it was actually Lisa's hand sort of like banged on the table.
I know. And I know, I saw your I saw your eyebrows just kind of go up. I couldn't help myself.
No, my eyebrows were up on the number. I was just like, whoa.
You just were more restrained and polite than I was. You were just like banging on the table.
Andrew Hoddenhorst in the city trading floor exiting and just sort of slamming the door. There goes July.
It's a very visual, kind of visceral response. It was a surprise, and that's the reason why Peter Scheer kind of came out and said it was the best of times, it was the worst of times, it was a confusing time. Why are we doing it this way? And I think a lot of people are questioning why the data is being written.
We both said Friday morning going into that print, as soon as the show started, whatever the number is at 8:30, it won't settle anything. Won't settle a single debate. And that's what it felt like over the weekend. In fact, I'd say it poured more fuel on both debates through the weekend.
That's what I was going to say. Not only did it not give clarity, it actually widened some of the debates that continue to this day. So stay tuned. We've got more of them.
Andrew's not an aggressive guy. I can't see him, like slamming doors.
No, but he might have just sat there being like, which would have been the equivalent.
Yeah, he's like quietly frustrated.
Quietly just imploding.
That's Andrew Hoddenhorst,
yeah,
for sure. Coming up, Sarah Hunt of Alpine Saxon Woods, Vijay Rakesh of Mizuho, BlackRock's Amanda Lynam and Mark Zandi of Moody's Analytics. From New York, this is Bloomberg.
If you're hoping for weak payrolls so the Fed may cut, you're really trying to thread a needle there.
I think the economy is slowing, but there's still pockets of strength.
The Fed can cut, but if they cut what's priced in, what essentially the market's calling for, you're not going to get any further easing in financial conditions.
They won the battle on inflation. They don't want to lose the war on the soft landing.
There's no way they can cut or signal a cut in July with this data.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Slamming the door on July. This was Citi, surprisingly strong job growth. This was JP Morgan, the recent momentum in jobs growth. It was all about a blowout payrolls report. Live from New York City this morning. Good morning, good morning. The third hour of Bloomberg Surveillance begins right now with equity futures on the S&P a little bit softer by 0.1% this whole week, Lisa. The first 2 days, it's all about inching closer and closer to Wednesday morning.
And the run-up really is going to be what is the threshold in order to tip the Fed toward even cutting rates as soon as September, because it seems like the bar has gotten higher. It seems like employment is not giving them the reason, so it has to come from inflation at a time where a lot of people are questioning the models. Yes, you're going to get that. We're not going to resolve that. But the reality is that rents aren't coming down as quickly as people think, and a lot of consumer sales are still going well.
I'm not just questioning the models, we're questioning the data still from Friday. We shared this quote from Peter Cheer of Academy Securities a little bit earlier this morning. Worth sharing again. The establishment survey makes it look like an incredibly strong and healthy labour market. There's another survey. The household survey makes it look like a very weak labour market. This is what Peter goes on to say. If we pick and choose the data to look at, it's the best of times. If we look at the other data, it's the worst of times. That's the issue right now for a lot of people. Not just is good news or bad news or bad news for stocks, whether the data is actually good or bad.
Well, and this goes to what some people would say is the K-shaped economy, the idea that there is a swath of the consumers, and swath is my word of the day, congratulations, that is not doing very well, and then that there's a whole cohort that is wealthy and just living high. So that raises a deep question if that's really what explains the dissonance. Other people saying that there just haven't been as many responses to surveys post-pandemic. They haven't really gotten as clean of a read, and that's why revisions have been so important and so significant in all of the subsequent months.
We talked a lot about the call from Citi. Andrew Honhorst and the team looking for this weakening in the labour market. They just published jobs data divergence deepens. The establishment survey shows 2.8 million jobs added over the last year. The household survey shows less than 400,000 new jobs over the same period and a steady rise in unemployment in recent months. How much weight do you put on one over the other if you're on the FOMC and you've got to talk about the labour market in the news conference on Wednesday?
They could probably say there are signs that there has been a sustained loosening in the labour market, which is welcome. At the same time, there's enough strength to keep the economy going. It's all good. Inflation's really going to be the focus. They're not concerned about the economy falling off a cliff, but they are sensitive to that, basically giving you nothing that you really want to hear, which is essentially where we've been, which is the reason why we've seen such great intraday volatility in a lot of the macro signals. And yet, at the end of the day, people are just sort of frozen in place.
That was the real promo for 2:30 and the news conference with Chairman Powell on Wednesday. Probably what the opening statement's going to sound like. Equities right now on the S&P just about unchanged. We're negative by almost 0.1% on the S&P 500. The scores in Europe, not good. The euro's negative by 0.4%. French equities are struggling. The French bond market is struggling. Lisa, there's a political element, a dimension injected into European assets this morning.
The European parliamentary elections came in pretty much in line with what a lot of the polls said, which is essentially a shift away from some of the centrist, classic Democratic parties and toward some of the more far-right constituents. Question is, what's the significance? Well, Emmanuel Macron answered the question by saying he was going to hold a snap election. On a larger scale level, from a market perspective, how much does this show that election risk is not sufficiently being priced into assets? Because nobody can price in exactly how things are going to transpire, but that it's still a risk. And that, I think, is something that really I was interested in over the weekend.
Because it's hard to gauge the outcome from the outcome. And we saw that over the weekend. We knew what the outcome would be based on the polls. And if we'd said that's how this is going to play out, would you have guessed he'd do a snap election? Same, I think, applies to the election that's going to take place here in November. If I can tell you who's going to win, do you really know what they're going to be able to do over the next year or so? I think that's tremendously difficult to do, which is why we've said repeatedly on this show, we're flying blind into 2025. We really are.
And we don't understand what the reaction will be in the subsequent days and weeks of the election. Will it be determined? Who will respond in what way? Things that transpire from the outcome that we cannot predict, which is a reason why people are saying you need to hedge in certain ways, but no one's making a massive call one way or another.
Super complex stuff through the next 12 months or so. Coming up this hour, a little bit more straightforward for you. Sarah Hunt of Alpine, Saxon Woods on what May's payrolls report means for the Fed. BlackRock's Amanda Lynam on why she expects a shallow rate-cutting cycle. And we'll catch up with Mark Zandi of Moody's Analytics, looking ahead to CPI on Wednesday morning. We begin with our top story, bracing for the Fed's two-day meeting. Sarah Hunt of Alpine, Saxon Woods saying this: just when you think you can make a case for a summer cut, in comes the jobs number and takes it off the table. While that noise we all heard is likely the sound of the door closing on July, the inflation numbers will add or detract to the evidence being used by the competing yes, they should, and no, they shouldn't camps. Sarah's with us for more. Sarah, good morning to you.
Good morning.
Never mind good news, bad news. What was Friday? What was that?
I think it was mixed news, right? You start to have all these discussions about the differences between this survey and that survey, and can we count on this, and what is the birth-to-death model doing? I think it just is indicative of the fact that it's a confusing market, and I think that that is on the labor side, certainly, and I think that that's part of what's coming into play as we go forward. We started off this monster rally when the Fed basically said at the end of last year, or the October of last year, we're done raising rates, there's going to be an easing cycle. People built in a ton of easing, and now people are looking at maybe taking that away. And I thought that Lori Calvasina's note this morning was really interesting on, if we don't get one at all, you've got some weakness in the equity market.
I know Lisa's got thoughts on that, but before we get there, if the payrolls report slammed the door shut on July, can Wednesday morning reopen it?
Wednesday morning could reopen it because, as a number of people have noted this morning, it's not just the labor market that the Fed is looking at. If the inflation really looks like it's coming down, but to your point earlier, the housing market is not getting any better. Rents are not coming down. They're not looking a whole lot cheaper, at least not in urban areas. So I think it could, because you have that discussion of, are we cutting rates or are we normalizing? And obviously the market's going to take any cut as a start of an easing cycle. But if they can do something like the ECB did, which is basically say, we're normalizing, but we're hawkishly normalizing, and we're not going to cut, don't look at this as a cycle. It could certainly open it, but I don't think to July. I think it opens it later in the year.
On the flip side, if we get a hotter than expected CPI print, you were talking about Lori Calvasina's call, this idea that if there are no rate cuts this year, it could cause an 8% decline in the S&P 500. What if Jensen Huang comes out later this week and says that he has a new development that's going to build robots that do our dishes and take care of our children? Could that totally change any kind of sell-off?
Well, I think that there's already been a bifurcation in what a sell-off means. NVIDIA has not been part of any of that sell-off. You've seen other tech sell-off in ways that NVIDIA has not. There is a secular story there that is difficult to say that whatever is going on with the Fed is going to be important for that piece of technology. But there's also a big future element, and I think that that's what people are starting to recognize, is that you have to really go further into the future to try to monetize this, unless you're NVIDIA and you're selling them the chips right now. So there's a little bit of a thing going on right there, where there's a secular story in one part of technology, but a market story in the rest of technology.
And do you believe that we're currently at rates that could cause the market story to gain legs? Like if we stay here, for example, in the market, I'm not just talking about Fed funds rate, that could really crimp how people understand forward-looking profits for a lot of the companies in the other 493.
Interestingly enough, I think it's almost less about profits as what it does to things like the housing market, which is still pretty stagnant, and what it does to people who have been waiting for a chance to refinance, because the idea was we're going to hike, we're going to go very high, then we're going to come down quickly. That's not happening. So there's a lot of extend going on in some of the fixed income markets. And I think that whether or not the stresses start to be a part there, I'm less worried about the larger cash-rich companies on whether or not a higher interest, a 5% versus a 4.75 or 450 makes a big difference. But if you don't get a cycle coming down, there's a lot of areas where I think that there's some tension in refinancing.
So let's get into it. Places you want to be, places you want to avoid. What are they?
Well, I think you need to be in the part of the technology sector that's quite clearly throwing off buckets of cash and doing really well in almost any environment. I think it's hard to say that that's a place you want to stay away from. The oil picture just got more difficult for energy And I think that that's still something that is throwing off a lot of cash, throwing off a lot of dividends. You've got good buybacks there. Retail's very difficult right now. You've seen a bunch of retailers come out and say, you know, year-over-year sales are not doing that well, and we're kind of worried about the next couple of quarters. So there are areas where it's quite clear that there has been a slowing, and there are areas where there may be some acceleration, but the overall economic picture is going to weigh on some of those materials and energy kind of stocks. Some of the industrials are doing quite well and going to continue to do quite well. It's very pick and choose right now.
You hinted at something, that the longer rates stay at these levels, there could be some real credit stresses that percolate into something different. Can you give us a sense, walk us through what that looks like? How severe could that look? Is that a credit crunch? Is it a sudden plunge? Or is it just sort of a slow bleed on economic growth that just becomes more and more evident over time?
So I think that one of the reasons that you've seen, I mean, there has been some equity volatility, but not the kind of volatility you would expect given some of the things that have gone on with interest rates over the last couple of years, is that we've had all these government programs that came through in the financial crisis that people now look to say, you know what, if there's a really big problem with interest rates, there's going to be some sort of program to help them, right? So the whole issue with the banks that started last year, where the Fed said, okay, or Treasury said, you can go put us collateral at 100 cents on the dollar, even though rates have gone up and that collateral may not be worth 100 cents on the dollar. There are a lot of programs to deal with that. So I don't know that it's as much of a crisis as it would have been in past eras where you didn't have a kind of backstop on some of that. So I don't know where that goes, but you've seen commercial real estate have problems. You've seen even apartment housing. There's certain parts of the real estate market that are really showing some stress, and those are long assets. And a lot of those were financed at times where now if you have to refinance anything, you're looking at a much bigger number. And if what you paid for that asset is now problematic relative to where interest rates are. So I think that there's a question of what those assets are worth, but I also feel like there's an underlying feeling that there will be something if it gets really bad.
So just to sum this all up, and John was asking what you like and what you don't like. You do like big tech and companies that are just generating bucket loads of cash. Consumer cyclicals are a little bit questionable. How cautious are you, given that you just don't have visibility at a time when you also are charged with generating alpha?
Well, it's tough because you have a multiple situation that, I mean, if you take the, you know, to Peter Cheer's point, the top 10 stocks, 35% of the S&P, but you have a multiple issue in some of the other areas. And I think you have to be careful both about what you pay and what everybody's balance sheet looks like, right? This comes back to cash. Am I generating cash? Because if you're not, and or if you have any refinancing that you have to do, you have to be quite difficult. It could be quite difficult, so you have to be careful about that. So I think that you just really need to pay attention to valuations in a way that we really haven't had to in sort of a while, because you just now have more vulnerability on what happens with the rest of the financial picture and what happens with interest rates.
We started this hour and we were talking about politics, and I could see you out the corner of my eye, nodding along. 25. Have we got a clue what the next year has in store for us?
We do not.
How difficult is that as an investor?
It is difficult, but if you take the politics out of it and you say how much has the regime changed in terms of what that means for the equity markets, as long as you're not radically changing tax policy or you're radically changing a lot of the tariff policy. I mean, there was supposed to be a big switch when Biden took office about what was going to happen with China. It didn't really switch that much. There may be a change in immigration. We'll see what that could happen to the labor markets if you get a change in administrations. We don't know enough yet to start trying to figure out what that playbook looks like. And I think that's going to be very difficult to parse.
So do you shorten the time horizon, make really tactical calls, or just assume that things carry on as usual and there's no big change?
I think we're always looking for a longer picture, right? We're not very short-term traders. We're looking for a longer picture. This goes back to, am I generating cash? What does my balance sheet look like? What is the economy going to do? You look at the macro picture more because the political picture is going to change, and we just don't know how that's going to change.
Sarah, this was great. Sarah Hunt of Alpine, Saxon Woods. There is a lot we don't know about next year, right?
Which was, how do you have conviction to then make a bet? It's, you just have a slew of things you don't know. All right, now go, buy.
NVIDIA just seems to be the conclusion.
But that's actually exactly it. Again, this goes to concentration risk down the line, but for the moment, that seems like the sure bet.
It's a feature. It's an ingredient in the story, that's for sure. Equities right now in the S&P just erasing this morning's losses, almost unchanged going into the opening bell. With an update on stories elsewhere, with your Bloomberg Brief, here's Danny Berger. Hey, Danny.
Hey, John. To the point of politics, the euro is weakening this morning by about 0.4% versus the dollar. Meanwhile, French rates have hit their highest level of the year, with far-right gains in the European parliamentary election causing French President Emmanuel Macron to call for a snap election. Sonia Martin, who's the head of FX and monetary policy at DZ Bank, said the results reinforce her expectations for euro parity.
in case Trump wins the election, euro dollar is going to go to parity. And of course, that trade just gets more attractive when we have a situation in Europe, which is looking more and more complicated. That will make a downside euro dollar trade more attractive. And I think if we were to get this kind of scenario where things go downhill here and, we get Trump in the White House.
She went on to add that Trump White House makes sub-parity more likely. Martin spoke to me earlier on Bloomberg Brief, which are weekday mornings at 5 a.m. Eastern. Apple's Worldwide Developer Conference gets underway in California today, with the company's advancements in AI said to be the dominant theme. Apple, for its part, is expected to unveil a new suite of features that it will be calling Apple Intelligence. It will provide users with voice memo transcripts, custom emojis, and summaries of text and emails. Apple is also planning a more powerful version of Siri. Donald Trump is back on the campaign trail. He held a rally in Las Vegas last night. The presumptive Republican nominee said that he would scrap taxes on tipped earnings for hospitality workers should he win a second term in the White House. The pledge signals Trump's bid to appeal to Nevada's mass service industry, dominated by young workers and people of color, two groups that he's tried to focus on ahead of the Republican National Convention in July. And that's your brief, John.
Danny, thank you. More from Danny in 30 minutes. So this FaceTime AirPods thing is a real thing?
I guess so.
I thought it was just me.
Well, evidently not so much. Maybe they could fix that bug instead of coming up with Siri.
Shouldn't they be able to fix that?
I mean, you would think.
Do you know they brought a headphones company, Beats?
Yeah.
Like, how's that worked out?
Not well.
Still can't fix the headphones.
Yeah, I have a confession to make.
Go on, make one.
I like the ones that you just plug into the phone that have the cords.
You're not alone.
I prefer those. They don't run out. They don't get fuzzy. They don't have to be charged. If you forget, it's not a problem. Just stick them in.
Isn't that a Gen Z thing? Aren't they doing that? Ben Laidler this morning, didn't he have cable headphones?
Maybe I'm just, I'm old school. What can I say? It's refreshing to me.
I'm on board. I used to like that because, you just used to pretend you're doing stuff. And it was very visible.
Oh, yeah.
You had the cable. Busy. Don't talk to me.
Stop.
Got the headphones in.
Come on.
They know. It's not a secret, is it? Up next on the programme, the morning calls. Plus, Mizuho's Vijay Rakesh as Nvidia's 10-to-1 stock split goes into effect. That conversation just around the corner. The opening bell about 1 hour, 13 minutes away, with equities just about unchanged on the S&P. This is Bloomberg. Live from New York City, welcome to the programme. Equity futures on the S&P 500, just a touch negative, just a little bit softer. No drama this morning. And if you looked at the S&P 500, the close on Friday, Lisa, you'd say no drama at the close on Friday as well. You'd have no clue that 8:30 happened.
Yeah, basically what we're looking at is a market that's whipsawed on all of the potential economic data points because they have no clue and then ending up at the same place, which is a reason why long-term investors say they're not doing anything and algos are saying, but we need to do something.
I can't even say there's a trend in the bond market either. Because we're not even back at 450 on a 10-year. We're at 444, 93. Yields are higher by a single basis point. 2 years, a great story. Look at the 2-year from last week. Weak data, buy bonds, buy bonds. And then Friday happens, and the 2-year yield is higher on the week by a single basis point, even after the data we got on Friday, even with a 16 basis point move.
This is the reason why I care about the auctions. You've got $58 billion of 3 notes coming today at 1 p.m. Eastern. What happens if you get a big disruption that causes more volatility in the short term, in the long term?
That's some of the price action for you. Let's get you some morning calls. First up, Susquehanna raising its price target on Nvidia to 145. The analyst highlighting confidence in a sustained and smooth transition as the chip giant switches from its Hopper to Blackwell AI platforms this year. Next up, TD Cowen also lifting its price target on Nvidia to 140. The firm adjusting its EPS estimates and target on the back of the 10-to-1 stock split. And finally, Mizuho analyst Vijay Rakesh raising his price target on Nvidia to 127, noting the company's continued AI dominance. Vijay saying this: Nvidia continues to see strong opportunities with the Hopper, Blackwell and Rubin platforms announced at Computex for 2026. Its 10-to-1 share split should create a more attractive entry point for retail investors and could provide additional share tailwinds. Vijay joins us now for more. Vijay, I just want to start with that final point, and thanks for joining us again, sir. Why is that important? Sort of the equity market snobs would sit around this table, Vijay, and say it doesn't matter, it doesn't change anything. What do you think it changes?
Yeah, thanks for having me on, John. So on NVIDIA, our price was $12.75 pre-split. So, the 10-for-1 obviously accounts for that. Now, I think it does not absolutely change the intrinsic value of NVIDIA. But what it does is it makes it much more accessible for the retail side of the investing platform. So obviously, a $127 price target, $127.50 price target that we have, or post a 10-for-1 split, it makes it a lot, increases liquidity, makes it a lot more accessible to retail. And I think that is obviously an attractive proposition that management sees. And that's also a vote of confidence, because I think this is probably the second or third split that they've done in the last 5 years. So,
do you get the sense that other big tech companies are watching this in terms of doing their own stock splits going forward?
I think it's very plausible. I think, obviously, when you increase, there is so much retail participation in the market these days. When you increase the liquidity on the stock, obviously makes it much more accessible. It improves the trading environment, I guess. So, but like we said, it does not change the intrinsic value of the company. The fundamental, DCF or any valuation you do kind of stays the same, but just improves liquidity, improves accessibility for the retail side. So.
There have been a number of papers recently written about whether NVIDIA is a bubble, at what point it could be a bubble, at what point it could fuel a bubble in other big tech shares. A lot of people making the counter argument that it's actually generating boatloads of cash, so it's not really bubble-icious. How do you understand, what's your parameters of really gauging when enthusiasm has gone beyond the realm of possible and likely for a company that seems to be going through the moon, shooting for the moon, but it can't continue forever?
Yeah, I think two key things to watch. I mean, if you look at AI penetration in the server side, it's still less than 10%. It's still about 10% of the market. So there's still a long ways to go in terms of AI adoption, not just at the cloud, CSP level, not at the hyperscale level, but back into enterprise and in a lot of other markets. So there's a long ways to go in that adoption. Number two, when you look at the whole AI market, it's almost a $1 trillion market today, and about 250 billion of that is, you'll see about 250 billion a year of basically brown scale investment, basically upgrading existing infrastructure, an additional 250 billion of new AI investments. So that's about 500 billion a year of AI investments that are going to come through. And I would say also, don't forget, when you look at NVIDIA itself, number three, I would say, what they're selling today is Blackwell. That's only a $50,000 ASP product on an 8 GPU server. They are going to full stack servers in 2025, where the ASPs or the selling price of these servers are in the 1.5 to 3 million. So a very significant increase in their selling prices, and that'd be a big driver for the top line. So there's a long ways to go on this story. So,
Vijay, I want to talk about concentration risk, and not in the S&P 500. I want to talk about the customer base. We know, there was one customer that accounted for about a fifth of NVIDIA's revenue. UBS, I think, thinks that customer is Microsoft. Now, given the nature of their big customers, is that an asset, or do you think that's a future risk?
Well, I think you will see at any point, other OEMs step up. I mean, you're seeing Meta increase spending, you're seeing Amazon increase spending, you're seeing Google still on the come. But I think the new kid on that thing on the podium seems to be Tesla. They're definitely pushing on the XAI and their AI data center. So there's a lot of new orders coming from Tesla to NVIDIA as well. And you would also look at the whole enterprise platform that's still out there that's not really penetrated. So, back to the point, it's still less than 10% of server shipments. You're seeing very strong demand, but on the supply side, there's always some limitations there. So you can't supply to everybody yet. So,
Vijay, awesome to catch up with you, sir, on a 10-to-1 stock split day for NVIDIA. Thank you, sir. Bloomberg data, we've got Microsoft, I think Meta, Amazon, Alphabet, 40% of the revenue base for that company.
So far, that's been a feature, not a bug, because those have been the companies that have been able to spend big money.
They've got the cash. How long's the runway? Mandeep Singh of Bloomberg Intelligence keeps asking that question. How long is the runway? Up next, Amanda Lynam, Mark Zandi on This US Economy from New York. This is Bloomberg. Equities on the S&P 500. Bramo not happy. We'll share that for another day. All right. Not criticising when you're going on vacation. It's a beautiful place.
It is a beautiful place. Are you
so sensitive about these things?
All right. Big deal.
Hour away from the opening bell. It's not a big deal. In the bond market, the 2-year looks like this. Yields repricing higher on Friday by 16 basis points, pulling back a single basis point this morning at 487.62. This just in from Goldman Sachs. We expect the dots to show 2 cuts in 2024. They go on to say, Lisa, we think the leadership would prefer a 2-cut baseline to retain flexibility, but a 1-cut baseline is a possible risk, especially if core CPI surprises to the upside Wednesday morning.
Do they want to surprise the market in some capacity? Do they want to sort of cast some cold water on this idea that they're going to be accommodative even without some sort of weakening in the labor market? That seems like the differential. If it's 2 rate cuts, that's pretty much in line with what the market's expecting. You can't imagine that there's going to be a really significant response. So that seems to be maintaining the status quo type of option.
You go to 1, you wonder what it might change. Let's go to foreign exchange. Dollar stronger against everything in G10 on Friday. This morning, the euro weaker again, this time by 0.4%. The weakness coming on the euro side of the story. Some political uncertainty for the Europeans weighing on euro dollar, back down to about 107.55, and that's good for where you're going later this summer. So that's a good thing. All right?
You're revealing too much. Yeah, it's true.
I'm not saying where you're going.
I'm wondering, if we could just get it down a little bit further, it would be even a better vacation. This is the reason why everybody is on a plane from the United States over to Europe. And actually, U.S. resorts are seeing the influence of that because they're not staying in the U.S. They're all going to Southern Europe in particular. I was just talking to some people about that.
20 nations in the Eurozone, I think, Bramo. So, no one knows.
Yeah,
it's okay.
But the truth is they're all going to 2.
As they often do.
Yeah. That's where all the American tourists are going.
Always surprises me. Number 1 is France. Always surprises me.
Yeah, well, it's Olympics.
Number 1 for global tourism or something.
Yeah, but
I don't get it.
It's Southern Italy
because when you get there, the French behave like they don't want you there. So I'm always shocked by it.
Well, it's like
their shtick.
But think about Japan. They actually don't want people.
You try and speak French, they're like,
true.
stop.
Yeah.
You try and speak Italian in Italy, and they're like, carry on, please. This is wonderful.
Really,
they sort of help you along.
Hold on a second. This got really personal, but you can actually speak some Italian. When I try, they're just like, I can speak English, please.
The French are just like, no,
Yeah,
stop.
yeah. Well, it depends where you go in France.
Okay,
like
true.
Aix-en-Provence is like very friendly, and Parisians are kind of Parisians.
Yes. All right, there we go. Good summary. If in case anyone wants to take advantage of the 107.55 on the screen right now. Investors keeping an eye on Wednesday's doubleheader. We'll get the latest inflation read with CPI coming at 8:30 Eastern Time ahead of a 2 p.m. Fed decision and Powell press conference 30 minutes later. Mike McKee's going to be a busy man this week. Michael, what are you focused on?
Where Lisa's going on vacation, I think. I mean, it's much more interesting.
Spin the 20-nation wheel. Take a guess.
There are 2 countries everyone's going to. Southern Italy is totally packed. That's what I hear.
Well, obviously, everybody's looking at Wednesday for CPI and then the Fed. The CPI number is going to sort of, as Ian Lingen of BMO put it this morning, set the trading tone for the summer because we won't get enough other data to really change people's minds over the rest of the summertime because we've got other events that will come in and affect people. So it's not going to be as much about the data. But we are going to get a kind of a weird CPI in the sense that the headline month over month is forecast to go down. And the year-over-year headline is expected not to change, whereas in the core, the headline the core month over month doesn't change, but the year over year goes down. So if we get an as forecast number, what does it really mean? Does it tell us that there's enough progress? Which leads into the Fed and the idea that they held off last time because not sufficient progress had not been made, significant additional progress had not been made. Would that count as progress to see the core go down a tick to 3.4?
You used the W word, something that Peter Scher used too, weird. He said that a lot of this data has been weird. And I'm curious about why it's so weird. Do you subscribe to any of these ideas that this is messier data than usual because there just are fewer responses to surveys, that potentially there is something going on with respect to how difficult it is to quantify, or employees not being in place, or whatever other conspiracy theories people are coming up with that are leading to some of the really significant downward revisions later on?
All of the above. It's a combination of things. The data all got messed up by the pandemic in different ways because it changed consumers' buying habits, for one thing. The data then didn't fit the historical data didn't fit a model going forward because people were behaving differently. We have seen response rates drop significantly, which makes it harder for the government statistical agencies to correct for that. The seasonals are all thrown off by what happened in the pandemic. So there's a lot of reasons why all this is happening. But what's interesting, when you get down to the bottom line of it all, Americans are still spending money. And that's kind of where the Fed is at. They're still getting jobs and they're still spending money. And we're not seeing huge changes in that. After the jobs report, the Atlanta Fed went up to 3.1% from 1.8. So
after being at 4.
We're still seeing stronger than expected growth. So the Fed has to make policy within that, and it just tells them they don't have to move if they're not certain.
I think it was 4, then down to 1, back up to 3.
I know.
That's like the last couple of weeks.
I know.
Isn't that just in the last 2 weeks?
Yeah,
yeah,
basically.
Amazing. Let's continue this conversation with Michael McKee. Joining us now is BlackRock's Amanda Lynam alongside Mark Zandi of Moody's Analytics. Let's set the stage like this. There's 2 surveys that go into the jobs report. Amanda, you know them well. 2 very, very different stories. What was Friday about?
Well, I think just taking a step back, as you noted, the overall establishment survey showed really strong momentum. Perhaps that might have been driven by some of the immigration that's coming into the country. The household survey showed a pretty meaningful decline, but that was really in folks that are under the age of 25. So it was really concentrated. And I think we've spoken about the bifurcation in the economy in sessions past. I think that's partly what you're seeing there. But in aggregate, as Mike noted, the economy is still chugging along, even if we expect some deceleration from, say, where the Atlanta Fed GDP now is, say we end the year at 2%. That's still trend or above trend growth. And I think for us, the shallow rate cutting cycle that we're expecting is really a product of that, because it's not obvious to us that there's urgency for the Fed to ease. We expect them to normalize, but not really to ease policy.
Mark Zandi, 2 very different surveys. From your perspective, would you put more weight on one versus the other if you're sitting on that FOMC?
The establishment survey, the survey of businesses, I think that's the better measure. I mean, it shows the job market's strong, resilient, creating lots of jobs. The job growth was very broad-based. But you can't dismiss the household survey and the increase in the unemployment rate. It does indicate that the labor market is really cooling off. If you look under the hood of the job market, hiring is weakening. We're seeing fewer quits. Unfilled positions are declining. Number of temp jobs are declining. Hours worked are declining. So, the job market's okay. It's fine. It's moving forward, but it's cooled off. It's, exactly where the Fed would want to see the labor market. Resilient, creating jobs, but, not at a point where it's feigning inflationary pressures.
Dialing this weird aspect of the jobs report into what we're expecting in terms of CPI on Wednesday, Mark, are we measuring inflation correctly?
Well, yeah, we're measuring it, but there's all kinds of problems with it. I mean, if I were king for the day and at the Federal Reserve Board and looking at the inflation measures, I'd be focused on something that's called the harmonized inflation measure, or harmonized CPI, or harmonized PCE. That's everything except owner's equivalent rent. That's a mouthful, but OER is this implicit cost of owning your own home. That is very problematic. I've learned a lot about this, digging deep into it. It's very problematic even when things are going well, the housing market is well functioning. But as you know, the housing market's a mess. We've got a very severe shortage of affordable housing. We have a surfeit of high-end housing, and that's just scrambling things. So if you really want to get a sense of underlying inflation, my view is you use harmonized. By the way, that's what's used in the rest of the world. And if you do, it shows that, mission accomplished. We're there. Inflation's back to the Fed's target, and it has been for quite some time.
Amanda, picking up on that point, I'm glad that Mark brought up the housing market. We heard this from Sarah Hunt also, that this is actually completely skewing a lot of the measures that we're looking at because the housing market's broken. And this is a key aspect of the U.S. economy and input into inflation. How much are you watching that and sort of using that as a gauge of credit strength more broadly?
Yeah, it's part of the reason why we like to look at the super core, which is the services X housing. We're looking at a range of metrics when we're looking at the degree of restriction of monetary policy. I think from a pragmatic view, we're not expecting major changes to the Fed's inflation targets or the reaction function. I think they need to get to their target before they even think about kind of reevaluating evaluating whether or not these metrics make sense in this new cycle. But from a credit perspective, we're not seeing a massive degree of restriction across the credit landscape. We're seeing it in pockets, but we're not seeing it widespread. And so there are certain areas where, sure, borrowers would love to have some rate relief, but is 25 or 50 basis points going to move the needle for them? Probably not. And it's really the depth of that cutting cycle that really matters for risk appetite. But I think the good news is that most of these corporates are managing this backdrop in a resilient way. It's largely a function of growth, however. If we have a significant slowdown in growth and we have persistently elevated cost of capital, I think that's where we could become much more cautious.
Have the sources of finance shifted? We've talked a little bit about this over time. Does that make it more difficult for the Fed's policy to really get to maybe where it needs to go?
They have shifted in the sense that you've seen private credit play a bigger role. But even in the syndicated markets, we're seeing significant demand for leveraged loans, both from investors and for borrowers to issue there, because the demand is so strong. CLO creation is high. There's a lot of technicals are really important in the credit market. But I think, yes, the sources of financing have kind of helped out a bit. But in general, the tone is just still very strong. And I think part of that is a function of corporates entered this period from a position of strength. But again, the growth has allowed corporate credit to absorb the higher cost of capital. I think it really hinges on growth. Even on Friday, the yield back up, we saw buying in IG credit, right? We saw investors coming into the market when we had a 15 basis point backup in yield. So it shows you the strength of that demand is really there. So it's hard to get incredibly negative on corporate credit spreads, because even when it tries to sell off, you see either in spreads or in rates, the buying comes in.
Mark, it's really difficult to reconcile the conversation we have on Wall Street with the conversation you hear from FOMC officials around the issue of financial conditions. Can you tell us what is the difference between a Federal Reserve official saying financial conditions are tight and people on Wall Street still saying they're easy?
Well, I think they're right where they need to be. If you point to the equity market or the credit spreads, it feels like conditions are easy. But if you look at bank lending standards and the banking system in general, not so much. Credit is much tougher to come by. So the value of the dollar is strong. That's consistent with tight financial conditions. So if you add it all up and mix it up in a pot, feels like financial conditions are right where they need to be. So yeah, you can find things that show that they're easy, some things that show that they're tight, but all in, it feels like, again, the Fed's got financial conditions exactly where they want them.
At this point, though, Mark, how much is this boiling the frog? And this has been sort of one of the questions with the long and variable lags that, we're sort of doing damage under the hood that's suddenly going to come to the fore. And that was the belief earlier this year. It was a belief last year. And then people abandoned that, said actually things are just fine and we can live with rates right here. Do you have a sense of which it is, of where the balance of risks is in terms of holding conditions at this level for just a longer period of time?
Yeah, well, the most likely scenario is the Fed's going to pull this off, the economy is going to soft land, and they'll start cutting rates here pretty soon, and things will settle in. But I do worry that they're holding on here too long, that's too high for too long. The labor market has signs of weakness. I went through a litany of those. The financial system is fragile, it feels to me. I mean, the yield curve is inverted. Short-term rates are still above long-term rates. That's not, consistent with a well-functioning financial system. That, it's a very uncomfortable position to be in for the system. So I've got this image in my mind of the system as an engine, and it's shaking tremendously under the stress of these higher rates. And so far, it's held together with a little bit of duct tape and some help from the Federal Reserve and banking regulators, but for how long and why? Why would you do this? I mean, I think mission accomplished. I mean, full employment, 4% unemployment rate, inflation's back at target, properly measured, and has been for a long time. So why take the risk? So yeah, I do worry about that scenario. I don't think it's off the table, and I don't think we can take it off the table until the Fed starts lowering interest rates.
You wrote about it in the Washington Post. Note to Fed, it's okay to cut interest rates now. Sort of goes against, Mark, what we heard from Bill Dudley, who said the Fed thinks it's fighting inflation. Think again. How would you convince the Kashkaris of this world this week in a two-day meeting starting tomorrow? What would be the sort of cheat guide you'd say, you're wrong, this is the way I see the world?
Well, there's nothing that's going to convince anybody except data. So we get that CPI report. The consensus is that the core CPI comes in at 0.25, I think, to the second significant digit. And you need you need some 0.2s and 0.25s here over the next couple 3 months, and I think then you make believers out of folks on the Fed that they can cut rates. By the way, 0.25, you annualize that, that's just about 3%, a little bit over 3. That's on the CPI. You make adjustments because the consumer expenditure deflator is constructed differently. You're pretty close. You're within spitting distance of target. And by the way, we're still, I get it. We're slavishly holding this 2% target on the PCE deflator. I understand the necessity to do that because of the credibility and everything else. But really, at the end of the day, I mean, is 2% the right number? I think most people would say no, it's probably higher than that. So why sacrifice the economy to the altar of a 2% inflation target if you don't need to?
We've heard a similar argument from Mohamed El-Erian over the last couple of months as well. Mark, great to catch up. Mark Zandi there of Moody's Analytics alongside BlackRock's Amanda Lynam. Let's give an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. A check on Southwest Airlines shares this morning up nearly 8% in the pre-market. Elliott Investment Management has built an almost $2 billion stake in the company, that according to the Wall Street Journal. The size of the reported holding makes the activist firm one of the largest investors in the U.S. carrier, and that Elliott plans to engage with management. Tesla CEO Elon Musk's pay package is being put to the test at the company's annual meeting on Thursday. One of the company's largest shareholders, the Norway Sovereign Wealth Fund, said it will vote against the $56 billion deal. Norges Bank Investment Management says, quote, "We remain concerned about the total size of the award, the structure given performance triggers, dilution, and lack of mitigation of key person risk." NVIDIA's 10-to-1 stock split will take place today. Shares lower by about 0.7% this morning. The AI boom has powered the company to huge gains of more than 140% year to date. The share price surpassed $1,200 and the valuation passed $3 trillion. Goldman's David Kostin says that one of the key reasons for the split is to increase liquidity alongside retail activity. And that's your brief, John.
Danny, thank you. Appreciate this morning. Thank you very much. Up next on the program, Apple's AI vision.
They essentially have an AI-driven super cycle. Betting against Crook and Cupertino into an AI upgrade cycle, I personally believe is a bad bet.
Dan Ives there. Always one of the best, eh? You love that, Bramo. Makes you smile every time.
It's just so good. It's just he's consistently
bullish. Vision?
It's just,
sort of like the message, the style.
The style is great.
New York Post says he's the best dressed on Wall Street.
I saw that.
Yeah, I'm not sure what you think about that bit. Not sure what I think about that. From New York City this morning, good morning. We're probably going to spend this whole week talking about Wednesday, just Wednesday. We're going to do that Monday, Tuesday, Wednesday, Thursday, and probably on Friday as well. We are about 41 minutes away from the cash open. Let's check out the equity market first. Equity futures on the S&P 500 look a little something like this. We're negative by 0.1%. Yields are higher by 3 basis points on a 10-year, 446.50. Counting you down to that opening bell, here's your trading diary for the next 24 hours or so. Today, we will get a $58 billion auction of 3-year notes. Plenty more debt supply to come through the week. We'll get Apple's World Developers Conference starting at 10 a.m. Eastern Time. And tomorrow, the Fed kicking off its 2-day meeting. I know Lisa's super focused on that debt issuance, 3-year, 10-year, and 30-year through the week.
Well, and it comes right after the New York Fed's 1-year inflation expectations today at 11 a.m. Just curious to see when people start pushing back. That's my big question, and I think the auctions really highlight that.
Pushing back because of what? The better data that's pushing yields higher, or because of the indigestion around how much supply is actually coming to market?
Well, I mean, it's basically indigestion around what price? It's essentially price-sensitive investors coming into the market after the price-insensitive investors, some of the central banks globally, on the margins are pulling back. So the bonds can clear. It's at what yield, at what price, and that's what we're looking for in terms of indigestion, how much the banks can take down, and what it costs to really clear it in the open market.
You know, a big takeaway from the last conversation we just had, we were talking to Amanda Lynam from BlackRock and Mark Zandi from Moody's about the Fed decision on Wednesday, but big takeaway for me today is what she said about credit on Friday, that you had yields break out on Friday off the back of better than expected data, and people were buying corporate credit. The demand there was good. So what we're seeing basically is high yields on treasuries, but it's not crowding out what's happening elsewhere. And you can see that in the amount of supply we've had so far this year from corporate debt issuers and the amount of demand that sort of met it over the last few months.
The amount of cash that's been created in this global economy is just overwhelming, and that's the reason why there are a lot of dollars looking for places in the higher yielding space. Right now, the U.S. is looking more and more like the higher yielding space as other central banks in the developed world cut. So at what point does this sort of infuse the debt market in the U.S. with a sense of confidence, because a lot of buyers are coming in from external places with lower yields now?
It's not all about debt. It's not all about the Federal Reserve or CPI on Wednesday morning. At the single name level, there's a big event this week, Apple's World Developers Conference starting at 10 a.m. Eastern Time. I'm pleased to say that joining us now is Bloomberg's Jackie Davalos. Jackie, walk us through this big event and what we can expect a little bit later on today.
It's a big day here in Cupertino, California, where the Worldwide Developers Conference is being held and starts in just a few hours, John. Now, remember, this is a developer conference. It usually gives the developer community a sense of what software and hardware is coming down the pipeline. But this year, it's all about artificial intelligence. That will be the central theme for Apple, which, as you know, has been a little bit slower to publicly state just exactly how AI will fit across its products. We have a sense of just the things that are to come thanks to Mark Gurman's reporting. And one of those is that Apple's new AI system will be called Apple Intelligence. This is going to kind of use the more generative AI that we haven't seen just yet. Apple is not a newcomer when it comes to AI. We have Siri, we have other apps that, the health assistants that infuse AI into its systems, but generative AI is really what we're looking for here. Those features will be announced. And the other thing slated is a highly OpenAI partnership, which will unveil a chatbot across AI systems. They haven't announced their own chatbot to date. It's kind of been seen as a laggard in comparison to Microsoft and Google. So this is a big day and definitely one of the most high stakes events for the company this year.
Jackie, Apple has a reputation of being late and being perfect and actually trying to nail something. This time, how much are they racing to catch up, being messy and willing to break some things?
It's definitely a risk. Apple has its own large language models, but it's looking to partners like OpenAI. It's also having discussions with Google's Gemini, as Mark Gurman reported, to be able to incorporate some of the already made products that are out on the market. Now, this comes with its own risks, but as we know, Apple's strength here really comes through in its devices. And so even if this isn't, a big success, a lot of users will be using it. So it allows them to really iterate on what they learn from how people are interacting with this. The future, really, when it comes to artificial intelligence, depends on just how we interact through voice control, for example, allowing users to be able to control those without having to look at a screen full of apps. And this is really Apple's advantage because they do devices so well, Lisa.
Jackie, this was great. Looking forward to your coverage throughout today on Bloomberg TV and radio. Jackie Davalos there of Bloomberg in Cupertino, California. Apple, that stock is actually positive on the year now, year to date by a little more than 2%. And the carrot over that stock for the rest of the year, this year, is going to be September and that new iPhone. And how many of these features will be installed?
No, the big thing that's hanging over it is September. Will Jonathan Ferro go to an iPhone store, an Apple store, and actually purchase a new one because he's been holding off in order to get the latest iteration? You want to be the guinea pig?
Well, now I realise that the AirPod FaceTime issue isn't a personal, unique issue, that actually it's just a broader issue. They could just fix that, right? And then I won't need to upgrade.
Why not just use the plug-in?
I'm just not the audience. I'm the last guy to move.
It's true.
Like years down the line.
Yeah, well,
I'll never be that guy.
It's
I'm
the
just not the forward-looking technological expert.
And the technological people who want to sort of explore the next thing and want to understand. Do you want to look at a blank screen and say, hey, Siri, give me the number for this?
Don't even use Siri,
clients.
I
know, but my phone's actually
Two
going
types of people.
right
Two
now.
types of people, right? Headset people, the people that went and bought one, and the people that didn't. I'm like the guy that didn't. And you didn't either.
Hold on a second. Whoa. Pause.
Two types
I don't
of
think
people.
that many people went and bought the headsets. It was kind of a limited product.
Sure.
But it's a pretty
But
narrow
they're the first
slice
ones
of
to
people.
walk
They're the
around
first
with this
to adapt.
stuff.
But I think that there's
use
a
it
broader
properly.
group of people who have brought our
Do you want an argument about this?
Deeply. This has been what I've been waiting for all weekend.
I don't. The opening bell, it's just around the corner. 34 minutes away. Tomorrow's lineup: Russ Kostrick of BlackRock, Dan Ives of Wedbush, Omar Aguilar of Charles Schwab, and BNY Mellon's Alicia Levine. Is this about your vacation that you're upset about?
Well, Julia.
Because you're not in Italy. I know. We've got to sort that out.